right, so good morning, respected members, ladies and gentlemen, boys and girls, and distinguished guests and speakers. A very warm welcome to all of you. Today's topic, OECD Pillar 2 and the UAE minimum tax, the journey from 9% to 15%, might sound like a corporate thriller, but at the end of the sessions, I promise you, you will not just understood the plot, but you will be ready to advise the main characters. And I must say, you also can feel that it's a rare Saturday morning when we are not discussing these debit, credit, corporate tax filings, deadlines, transfer pricing. Instead, we are talking about Pillar 2, a topic that makes CFOs to skip their sleep and consultants to skip their vacations. But jokes apart, but that's the beauty of our profession, that we don't just adapt to change. We decode it, we simplify it, and then we teach others how to deal with it. I think that's what makes the ICI community truly special. I think we all deserve a round of applause for this. And before we move ahead with the technical brilliance, let's take a moment to honor the two nations that have shaped our identity, the UAE, India, and of course, the pride of being chartered accountants, our ICAI. May I request everyone to please rise for the national anthem of these two wonderful countries and followed by the ICI motto. Requesting technical team to please play the national anthems.
जनगणमन अधिनायक जय हे भारत भाग्य विधाता पंजाब सिंध गुजरात मराठा द्राविड़ उत्कल बंगा विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा तव शुभ नामे जागे तव शुभ आशीष मांगे गाहे तव जय गाथा जन गण मंगलदायक जय हे भारत भाग्य विधाता जय हे जय हे जय हे जय 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 हे
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता
Thank you. Please be seated. Good morning once again. It's a very lower, and can I listen this on a higher note? Good morning. That's a better one. So members, today's sessions is truly a special one when we talk about the pillar 2 and move from the 9% to the 15% corporate tax. We are not just discussing a new number. We are witnessing the evolution of the global tax landscape. And across the world, countries are redefining how business contribute to the economies they thrive in. And the UAE, true to its vision, it's aligning itself with those international standards of transparency and fairness. And for us as a financial professionals, this transition is more than just compliance. It's about competence and confidence in guiding our organizations and clients through this new era. And what makes today's even more exciting that we are not just going to learn what pillar 2 is, but how it impacts real world businesses through experts' insight, practical examples, and interactive discussions. And trust me, by the end of this workshop, you will see that this top-up tax might top up your knowledge for more than your payable tax. So it's giving me the immense pleasure to formally open this session. So thank you so much and welcome once again to all of you. Thank you. And as the secretary of this vibrant chapter, it fills me with the immense pride. See that how ICI Dubai chapter continues to bring global conversations to our member well ahead of time. And this is possible only because of the vision, teamwork, and relentless commitment of our managing committee under the leadership of our chairman, CA Jayaprakash Agrawal. On that note, it's my honor to invite our chairman, CA Jayaprakash Agrawal, a true example of leadership through the action to address our members. Please join me in welcoming CA Jayaprakash Agrawal on the stage, ladies and gentlemen.
Good morning. Let me start by saying, don't try to be the best on the team. Don't try to be best on the team. Try to be best for the team. These are not my words. These are said by a motivational speaker, Brian Tracy. And today's session on OECD Pillar 2 journey from 9% to 15% has been arranged with the same objective. Idea is to ensure all of us together is best for the chapter. We collectively all perform best, and Indian chartered accountants are considered best because early we adapt, early we learn, early we able to shine. Now let me say good morning and hello to all my seniors and fellow members. अभी भी जान नहीं आई सर, मेरी तरह एक बार जान से बोलिए गुड मॉर्निंग. अब लग रहा है मैं ICI Dubai chapter के स्टेज पर खड़ा हूं. Before I speak more about it, let me first drive you through the calendar because it's almost my calendar is over, so let me go ahead with and give you 3 months calendar now. But before I do that, how many of you are below 40? Yeah, up to 40, age of 40. Raise your hands. Perfect. नहीं सर, हार्ट पे नहीं, एक्चुअल 40 की एज चाहिएगी. हार्ट पे तो मैं भी 18 से ऊपर गया ही नहीं हूँ. आई एम स्टिल 18. Okay, why I ask you this question is because ICI India is doing something called Business Leader, CA Business Leader 40 under 40. If you are under 40, please participate in this. Why? Because I want to say by the end of this year that हमारे पास भी एक business leader है 40 under 40 who won from India and brought the trophy to Dubai. Will anyone one of you will participate in it? कोई participate नहीं करेगा? Yes तो बोलिए yes you will participate. No. जोर से बोलिए yes. And please bring the trophy home. This is the nomination link. Please go take a picture of it. Go check the conditions. This is done by your own ICI India 40 under 40 Business Leader Award. Normally Dubai chapter करता बहुत बढ़िया है, but जरूरी है कि we participate and show to the world also yes Dubai is doing something. So that's for that reason if you are 40 under 40, please participate. This is a link coming from India. ICI India is saying please do participate, and this time I want to stand on the stage one day and say trophy Dubai भी लेके आया है under 40 के लिए. Okay, thank you. Now moving ahead, I'll show you the calendar. What exactly the calendar we are planning followed by leaderboard, because we have 4 initiatives going on this year. Annual conference is on 22nd, 23rd, and the leaderboard, people who are leading will be getting the awards, or at least a recognition or a thank you note from us. And what's in store after that? Okay, calendar ahead. This is something which you always wait right now, because we give 3 months calendar. So let me see it. We are sitting in October. Now, after this event, we are not doing anything. We are directly going and doing something on 2nd of November, which is a Diwali event, where family comes together to celebrate. This is one event where Kutle Khan will be coming in to perform. There will be a proper carnival for you. We will have 11 to 12 games waiting for you to come along with the family and play those games. And then we will have a musical night and Thambola, the way we do it. That is on 2nd of November. It will be in Etisalat Academy, right? This time we have changed the location. So Etisalat Academy, we have planned for it. Moving on, then 22nd and 23rd, we will have a 43rd annual conference, Udan. Okay, we have already shown you the teasers. I'll show you something which you have not seen in LinkedIn. How many of you seen LinkedIn? Some of the celebrities who are coming in. Perfect. मैंने सब कुछ disclose नहीं किया. क्यों? I wanted to disclose something to you because you have taken the pain of coming in the morning and attending the session. So I'll give you some people who have already confirmed who will be attending this event. One is, obviously you have seen in the LinkedIn, Sasi Tharoor is coming. He will be the, yes, he needs that applause. He will be the person who will be attending this event, and he will be one of the chief guests for the session who will be doing the inaugural and speaking to us. Followed by, we are looking forward for Sania Mirza to come in. That's a disclosure for you. We have not given it on LinkedIn. So Sania Mirza will be coming in. Sir, तालियां बजा दीजिए क्योंकि नाम और भी आने वाले हैं, लेकिन तालियां बजेगी तो उनको भी अच्छा लगेगा कि हाँ, हमको ICI दुबई पहचान रहा है. Next, we will also have Sonali Bendre coming in, a very resilient story of how to survive a thing where we give up hope. उन्होंने hope नहीं खोई थी. I want my members to have that hope from her. So Sonali Bendre will be coming in. And then one of the chess player, differently able chess player, he is not able to see it, but he is still a chess player. He will be coming in. Darpan Inani is coming in, and many more are coming in. These are few names for you for annual conference, which we have already confirmed with them, and they will be coming in. So please look for the flyer, which will be, we are planning to release somewhere in the month of last week of October, so that at least you get 3 to 4 weeks to register. We want everyone to attend in, and that's why we'll release it somewhere in the end of October. And these are only few names which I am disclosing you. After Udan, we will go for a break, and before the break, there is a holiday coming in. So 28 to 3rd December, if you're looking for a holiday, you will see by next week it will be coming in your calendar. Germany and Amsterdam we are going. This will be a 6 days, 7 nights event from 28th November to 3rd of December. If you are planning to do very limited seats, because it's a holiday season, it's completely packed. We are able to get only 40 seats. So once it is released, if you're planning to go for it, please register and please also pay for it. That will be November for you. Moving on to December 14th, we are planning something on wealth protection through wills and inheritance. Why I'm saying it? Sir, we all focus on earning wealth. We all focus on getting money for ourselves. One thing which, as a chartered accountant, as a human being, we are lacking is to protect it. हमारे जाने के बाद हमारे wealth का क्या होगा, ये मैं मानता हूँ, we are not worried. But somewhere we are required to protect our wealth. We are required to do a will and inheritance planning. How exactly it should be done. And it has to start from us if we want our future generations to use it. That's why we will have something on wealth protection through wills and inheritance on December 14th. Followed with, first time we will also do an outdoor cricket tournament. How many of your youngsters who are looking for outdoor cricket tournaments? If you are looking perfect, this time we will do an outdoor cricket tournament that is on 20th and 21st of December. Friday, Saturday and Sunday, 2 days outdoor cricket tournament. It's not indoor, it will be outdoor for you guys. The first time we will do it. That is for December. And the last month, January, which I am planning is 11th January, family business and its dynamics. Kal, aaj aur kal. We'll try to bring in and understand how exactly the past chairpersons of the family businesses, followed by the current ones, and the youngsters who are coming in, how they are thinking about family businesses. That is something we want to learn. So we'll try to bring 2 or 3 family houses with all the 3 perspectives, kal, aaj aur kal, and then we'll try to understand how exactly family business in this part of the world, which is very prominent, is growing. That is on January 11th we are planning. Followed with January 25th, the future capital or just a hype. Let's be realistic. We already have VARA. We already have regulations. OECD guidelines have also been out for cryptos. So cryptos is still a hype, or it's actually a wealth which can be created. We'll try to understand that. I'm trying to bring in VARA as well on the dashboard. VARA is basically your virtual asset regulatory authority in Dubai. We are trying to bring them and see what exactly VARA can do. can our members also capitalize on it? So that is something on January 25th we are planning. And then one event, a flagship event, not from us, from all of us. Being a chartered accountant, ICI India is doing a WOFA 2.0. That is on January 30th to February 1st, 3 days. 30th January, 31st January, and 1st of February. WOFA 2.0 in Noida, Greater Noida. So obviously, once all the details are available to us, we'll make more things available for you. So that is something is the calendar for you for November, December, and January. Okay, moving on. I've given you the calendar ahead. Let's go to the leaderboard. Top influencers, total member as on date. Who was the top influencer? The person who has introduced maximum number of members here, right? We are standing at 3,160 plus members in the last 43 years. This is the highest number which we have achieved. And trust me, this has not been achieved by your managing committee. This is something which you have done as a members, because out of this, 108 members got added through influencers. That is, you were the person who took the flag and say, please join ICI Dubai chapter. 108 members joined because you recommended, not because of the managing committee. If 108 members joined, how many members recommended it? 87 members in total out of 3,000 went ahead and referred someone who joined the chapter. Out of 87, when I was going through the data, 76 members followed the step of each one bring one. At least they brought one. Each person brought one member to the member, that is 76. 9 members followed the hum do hamare do. मैं एक नहीं दो लाऊंगा. So they brought 2 members to the chapter, and the only 2 members who are leading the charts, who are on the highest side, is these 2. And you might be familiar, they both are in my team. Dikshit Kumar Jain with 10 members, Vijay Mohan with 4 more members. You can stand because you have done that part. Vijay, Dikshit is there. Dikshit लंदन से कल रात को आया और अभी भी यहाँ अंदर नहीं आया. Okay, perfect. So they have done it, and obviously you can see the leaderboard for top influencer will go to Dikshit Kumar Jain on 22nd and 23rd of November annual conference. And why I call it an influencer? Because 9 committee members does not decide what will the chapter do. It is basically all of us, 3,100 decides what chapter will do. And these 108 members who joined is because of you. Thank you, Dikshit. And Dikshit, here he comes for bringing in 10 members to the chapter this year. Moving on, Power Performer. Power Performer was one person who introduced speakers. And when he introduced speakers, the speaker also took the stage to do a speech for us, to do a motivational talk for us, to give us a knowledge and learning. In total, 22 speakers have been suggested by members. Yes, as committee we bring speakers. As committee we have been trying to bring good speakers. But this year, 22 speakers comes from member. They all came as a suggestion from members. Out of 22 speakers, the people who recommended 16 of you, or 16 of among us, or all of 3,100 people, recommended 22 speakers. The list is this. And obviously you can see the list is little hazy because of the maybe pixels. The person who is leading is Rajesh Malgani with 3, and he is called the Power Performer. If nothing changes till November, then obviously he is the Power Performer, and he'll be awarded and said thank you from the stage by Institute of Chartered Accountants Dubai chapter. Give him a round of applause because he has 3 speakers and he is able to bring them on the stage. Moving on, Master Blaster वो होता है जो century मारता है, right? The person who brings in sponsors, bringing in sponsors, asking someone to invest in chapter is when you trust the chapter. When you have that confidence chapter that yes, this sponsor can be benefit from chapter. That's why we call it Master Blaster. We depend on him. That is why Master Blaster. 2 members did this job. Out of all 3,100, 2 members actually referred, and we were able to convert. These 2 members is basically Unni Krishnan and Mr. Shayan Shah. One got an annual sponsor, one got an event sponsor. These are 2 members. And since annual sponsors paid us the highest amount of 125,000, the leader for Master Blaster is CA Unni Krishnan S. And if nothing changes till November, yes, he will be awarded for his contribution to the chapter. The last one is top contributor in any form, in terms of voluntary doing anything for the chapter, in terms of suggesting new things to the chapter, suggesting new venues for the chapter. So one person who did it till now is Rajesh Raichura, and he's the top contributor for this year. These are the 4 awards which I announced when I took over in April. And these 4 are your leaders who will be taking the trophies from the stage of annual conference this year. Give them, all of them, a round of applause for doing that, because they took that effort of doing it. Okay, moving on, I have given you the leaderboard. After this, sir, January tak to calendar you have already given. What you will do? What's in store? I am only talking about February and March, what I am planning to do. and with this, my journey will come to an end. What I'm planning to do in February, March is one is technology summit. What lies in future? That is something we should know. So that's why I'm planning to do a technology summit in the month of February, March. Dates are still not decided, but something which is in my cards, which I'm planning to do. Followed by Indian budget, obviously, once it comes. हमारी इच्छा क्या होती है to know NRI impact. So we will do something on Indian budget and NRI impact when the budgets are out from Indian perspective. Followed with IWD. The woman needs to be empowered, needs to be celebrated, and that's why they are the superheroes. So we will be doing an event on with International Women Day, IWD. And finally, it will be a 2-day resident workshop I am planning to do, if I am able to do it. A resident workshop is taking you out from your homes, taking you to some other isolated location for 2 days in a resort or something, and then we do a learning either on IFRS, on corporate tax, or any other topics. So something 2-day resident program which I planning since January, but till now we are not able to do it. So we will do one resident program before I end the journey. With this, my PPT is over, and let me go back to the event. And it is not working. Okay, perfect. Now, about this event, how about this event? This journey from 9% to 15% is not simply a matter of numbers. Today, you will not learn everything, my dear friends. Please understand that you will not become a master today. What we are trying to do is, don't think about what you can do. Don't think about just learning the calculation mechanism. Today, we are trying to give you an experience and get a hang of those building blocks, those foundations. We are trying to make it comprehensive by bringing in the renowned consultants. Big Four representation is also there. Industry experience is also there, so that you get a complete comprehensive information about OECD Pillar 2. It's a complex subject. It's a boring subject. Trust me, it's a boring subject. It's a complex subject. But as a chartered accountant, हमने बोरिंग तो आईटी की भी सही है, इंफॉर्मेशन टेक्नोलॉजी भी सही है, सो वी कैन अंडरस्टैंड दिस टॉपिक. माय ऑब्जेक्टिव ऑफ ओईसीडी पिलर 2 completely end to end is to start thinking of those lines. I'm not saying master it, but at least have that proactive approach to start early, so that the learning, understanding, and knowledge building of all my members happen in a systematic and progressive way. Let us utilize this opportunity to build a robust foundation for the future, a future for yourself, also for future for UAE, because I want, if the country has blessed us so much, we are able to project UAE as a transparent and equality giving country, and that is why we are doing it far now, so that you can plan for it, you can learn faster. By end of today's event, if you take home effective tax rate, if you are able to understand effective tax rate, understand financial accounting adjustments which need to be done in computation, understand safe harbors, and also understand the globe information return. Trust me, your journey of Pillar 2 has started on the right note. If these terms you are clear, if these logics and concepts are clear for you, I guess you have started on the right note. Thank you very much, and let's start the event now. Thank you.
Thank you so much, Chairman Sir, for giving us the glimpse of our much awaited AIC as well, and for sharing us the calendar and those insightful and the motivating words as well. Your message truly sets the right context, reminding us that the adaptability and the preparedness are not optional anymore. So, and as we step into the technical heart of today's workshop, we couldn't have asked for more fitting start than our first session, led by someone who has been decoding the complexities of corporate taxations long before Pillar 2 made headlines. To do the honors of formally introducing him, I now invite our dynamic Vice Chairman, a true thought leader and one of the driving force behind our chapter's Year of Growth theme 25-26, none other than CA Rishi Chawla. Can I have a huge round of applause for Rishi Chawla, please?
Thank you so much, Secretary Sahab. I think our chairman needs a big round of applause. I think the way, thoda sa baja do, I think we should hear it out. I think he started this journey in a very emotional way, and he has presented 3 days in advance always. And the emotional, the way he's carrying, I'm always impressed and learning a lot from you, Chairman Sahab. Well done, and we always love you, and you are one of the stars we have. So good morning, dear members and my colleagues, my seniors here. We are having a very bright today, and now we have Pillar 2 with us. Just when we thought we have survived the hurricane of the first corporate tax deadline with last minute emails, reconciliations, and more coffee than sleep. We are now find ourselves entering the next chapter, which is Pillar 2. As you know, the cabinet resolution has introduced global minimum tax rules for the MNE above 750 million euros, and it's going to start from 1st January 2025. So we are already in the year which is when it is getting implemented. But this isn't just a follow-up rule, it's a global reset. But before we jump into the actual idea of what it is, I think the more important question is why we have global rules, why we are having it. And to talk about this particular subject, we have a very senior person, a tax guru with us, CA Nirav Shah. I'm sure his name does not need an introduction, but let me share some of his achievements. A CA with over 15 years of experience in corporate advisory, consultancy, and compliance. He is one of the founders of FAME Advisory. Prior to co-founding FAME, he has held senior positions in organizations such as Dimexon, KPMG in India. A person, I personally feel, a person with sharp knowledge and ability to read between lines, and who always have a bright smiles and a very pleasant presence whenever he walks onto the stage. So with that, let's welcome CA Nirav Shah onto the stage. Give him a round of applause because he is one of the well-wishers we always have we found to solve important questions for us. Thank you.
Good morning. So, let me first give a context. My session is also going to lay down the context and understanding of the subject that we are going to deal with. But why and how we thought about doing this workshop. And so, one is that UAE has introduced global minimum tax as part of its corporate tax regime, has issued cabinet decision to make it effective for all the covered entities within UAE, and therefore we thought it is imperative for our members to have an understanding of the subject matter. In fact, we also debated internally whether we should have this discussion also or not, given the larger context in which we operate, right? So let me give you the larger context also. We have with us Professor Vikram Chand, and I would have loved to have him, but due to constraint of time, he is not able to spend more time with us. But just to give you a context, OECD has been working on Pillar 2 for past so many years. By now, since 24, many countries started implementing Pillar 2, and the number reaches to almost 56 countries as we speak. And we have almost 30 plus countries outside the EU also who has implemented Pillar 2 in one form or the other. I was just at the IFA conference in Lisbon and was privileged to hear both sides of the story, because as you know that America, India and China are not implementing Pillar 2. And therefore, the largest brunt of entire compliance is coming on to the EU multinationals. And therefore, we also saw and heard some of the finance ministers of the provinces of the Germany requesting their own country that they should rethink about the Pillar 2 altogether. So, whether Pillar 2 will remain for us to be a long-term compliance, or will this be seeing something that we saw on the lines of economic substance regulation and maybe rolled back after a few years, we don't know. At the same time, it is complex. And at the same time, it is different to understand, because it does not, so what we told earlier also, we had, in fact, Ashna, thanks for reminding me, at ICAI, we had 3 years back, we had a session on Pillar 2, when it was just a concept, right, at the tax focus group. At that time also I had mentioned this, that if you want to practice Pillar 2, you have to first unlearn all your understanding of the tax. So if you talk about tax, corporate tax, and different deductions and computations and this and that, First, forget all that. If you don't forget that, you can't even discuss about Pillar 2. Pillar 2 starts with your books and only few adjustments to the books. Therefore, your understanding of IFRS will be at the center, then your understanding of the corporate tax rules and deductions and all of that. This is definitely on. I'm just checking the other mic. Then it can give me the freedom to move around, nothing else. Yeah. Okay, so I think better, audible still? Right, so one needs to unlearn that to actually apply the Pillar 2 or the rules which are made under Pillar 2. And if you will try and confuse the two, you won't be efficient. So those who are not in taxation, it's the best time for you to get into it. If your IFRS knowledge is very good, please start looking at it more clearly and more objectively, because these are more going to be dealt with on that level. Now, having said that, then let me just give you the context of what I'm going to discuss with you today. Okay, so we have just few things, again setting the tone of what the entire regulation is about. Thereafter, what I have done is that along with committee we discussed that how the session should be, and therefore we invited my good friend Jan and his team from Deloitte. They do lots of hands-on work on Pillar 2 with a lot of multinationals, and therefore we invited them to take us through the entire computation mechanism of how and where you need to work out. And just to support both of us of what we are talking as a consultant or as an advisor, we got two of the Rahuls to share with us the practical aspect of how they are looking at it from the corporate perspective, from the M&E perspective, and what the challenges they see to be there for them when they try and implement this whole aspect, right? So this gives you a 360-degree view of the entire subject, and then it helps you to prepare accordingly in terms of your mindset, in terms of your knowledge, and in terms of your efficiency, that where you want to start focusing more on. So if you are an in-house finance person, what should be your next priority? If you are going to be a tax person, a consultant, what should be your priority? And this you can define and start getting ready for that going forward. So again, my subject is more about the basics of what the definitions are, why, and what is covered, what is not covered, what are the safe harbor, and those part of it. So it just gives the context of what is covered within the Pillar 2. And then of course, Jan and his team will deep dive through the entire computation mechanism, and we'll have the practical perspective then later on. So if you look at this part, again, just some aspect why Pillar 2 came about altogether, that we had two problems with our system of current taxation the way it is, that it is not, we only tax based on physical presence, and we only tax based on domestic income that is generated from a country, based on our current set of tax rules and how kind of it evolved. And therefore it presented us some of the problem of current digital age, that you can do business from anywhere without having presence, and still you can generate a lot of revenues from any other country. And therefore all the US tech companies and all were doing that for many years, and therefore it was found that how do we tackle this aspect, and what do we do about it, right? Therefore OECD came up with this entire Pillar 1, Pillar 2 concept. Of course, the Pillar 1 part of it, and we'll talk about that also. Yeah, so Pillar 1 talks about the digital taxation, so mainly applying the basis or the thesis of the generation of, or thought about Pillar 1 was that if it is the digital companies, we tax them on the global profit and redistribute some of the extra profit that they earn with the source countries. Then US didn't come along, US didn't agree to that, and we are not going to see a light of Pillar 1 soon. And from what I heard at the conference last week, I don't think anybody is even thinking that Pillar 1 will come. Of course, OECD keeps trying, but that their job is to keep trying to do that, so they keep doing it. Pillar 2 fortunately, unfortunately, is already in the process of being implemented. So we'll go about that how and what. Of course, this pillar 1 or pillar 2 is more about prescribing a 15% global minimum tax on each country wherever the multinational operates. Okay? So in theory, we want to collect from every jurisdiction that a multinational operates a minimum tax of 15%. Clear? How and all will go into it. So like I said, 56 countries have so far enacted the global minimum tax of pillar 2 in some way or the form. Either they have done it fully with income inclusion rules, UTPR and DMTT, or some have only implemented the domestic minimum tax like the UAE has done. 33 countries are non-EU, and therefore it's not that it's only in EU that this is the trend. 9 jurisdictions have communicated their intention to implement, and South Africa just joined the list 2 days back, I think. And therefore, these are the numbers which are shared with us by OECD last week. So again, nothing that I have compiled or anything of that sort, okay? If we look at UAE and what it has done, because UAE is part of the inclusive framework that OECD proposed, it introduced the corporate tax. And along with that, we then brought in a provision whereby we could have introduction of the global minimum tax. And then we issued the cabinet decision number 142 to actually implement that. And as of September last month, that OECD also has now confirmed that the framework that UAE has put in place is indeed an acceptable framework, and it is therefore a qualifying domestic minimum top-up tax. What happens when it becomes qualifying, we'll talk about that a little later. As a basic concept, the construct of pillar 2 is something like this, that we want to charge minimum tax and at a minimum rate. The mechanism first is the globe rules, which takes into account the multinational entities' financials, does a computation. Then there are 3 different manner of implementing that. One starts with income inclusion rules, which is at the ultimate parent entity level. So you have ultimate parent entity in X country, that country in that tax department will compute the income inclusion rules at a global level, looking at each country that they operate in, and verify whether they are being charged 15% effective rate in every country that they operate. If yes, that's fine. If no, and if there is a shortfall, if nobody else has collected yet, the country of the ultimate parent entity will collect that under the income inclusion rules. Domestic minimum tax, like what we have for UAE purposes, that if you have subsidiaries or the branches of those MNE in UAE, and if they are not paying 15% tax, which is a fact as of now, then they will be required to pay the 15% tax to UAE first, because UAE has introduced the DMTT. And because our regime is a qualified domestic top-up tax regime, that 15% that you pay to UAE will be then included in your computation for IRR. And therefore, you will not have to doubly pay to the ultimate parent entity jurisdiction. So that's the context of it becoming qualifying domestic top-up tax regime. And under tax payment rule is a mechanism whereby if for whatever reason, due to treaty, due to interpretation or due to computation, if IRR fails to collect the 15% rate, then with the introduction of under tax payment rule, you can still collect the balance under those rules. Again, very few countries have implemented that. It's complex, don't get into it right now. It's not going to be immediately applicable for most of us. If we focus on DMTT, then that's more than enough for the time being. Of course, the second part of it is the subject to tax rules, which is at the 9% level. Now, this is a withholding mechanism for related party payments. And this is going to be implemented through a multilateral instrument, which will be signed by all the countries and which will come into force over and above the existing treaty network. And therefore, once it becomes or comes in force, when you make related party payments internally, the minimum withholding tax rate that will get applied will be 9%. at a concept level. Again, I'm not going into detail of that. And therefore, the way it works is that because withholding tax applies at the source level, at the transaction level, that gets collected first. And then, of course, the globe rule comes into effect. In that, of course, the domestic minimum top-up tax will first take the priority, and then the IRR. And if nothing gets, if you have still a shortfall after collecting IRR, you will go under the UTPR regime. That's the basic construct of the law. It's trying to address a lot of these problems, and therefore we have the law promoting tax equity, curbing aggressive tax planning, avoiding reputational risk, and so on and so forth. Okay. So when we look at the applicability, what gets covered is two things. If you are a M&E group, and if you have a turnover of 750 million or above, in 2 years of last 4 years. So these are again based on the numbers which you already have. So if you want to check your applicability for 25, all you need are last 4-year audited statements. Right? So again, we'll look at how it applies, but these are the two important terms that we will go into the details of. What is an M&E group? That's the first part, right? How do I define a M&E group? A group that consists of entities located in more than one jurisdiction. Even if I have a branch, I am covered. Permanent resident. Right? If I have a subsidiary, I am covered. More than one jurisdiction, if I am present, I am M&E group. Are we all clear? Therefore, all those entities which are included in your consolidated financial statement are part of your coverage. For whatever reason, if you don't consolidate certain entities, then they are not within your group. Then you see whether it applies under JV or other criteria or not, but they are not within the M&E group. Okay, and if you exclude them on the basis of solely on size or materiality, again that can also get excluded. An entity is any legal person or an arrangement that prepares separate financial account, such as partnership or trust. So everything gets covered. Okay, but only thing is where you need to maintain consolidated financial statements, right? So is an entity which, even if it is a permanent establishment, whether you have a formal branch outside or you just have a sales office or rep office, you can still have an exposure. So be very careful. Okay? An entity that owns directly or indirectly controlling interest and is not owned with controlling interest but is still consolidated. Okay? So again, main entity and all the A, B and C, as long as it is part of the consolidated financial statement, you will still be part of the M&E group. Joint ventures are treated as separate M&E groups. They are not, if you are not consolidating it, it's part of a separate group. They can appoint a domestic designated filing entity to pay in behalf of that JV, and calculations will apply as if the JV was the ultimate parent entity. Okay? So JV, in fact, under the Pillar 2 rules, there is a separate guidance entirely for joint ventures, and it runs into hundreds of pages. So if you have that situation, one needs to go into that guidance and go through that in detail. Second condition is the revenue threshold. Out of the last 4 years of audited consolidated financial statement, are you crossing 750 million euro in turnover? I've given you 3 examples here. If you cross in 2 out of the 4 years, you're covered. Even if it is last 2 years where you're set up and you are not set up in earlier 2 years, you are still covered. Right? So whether you are covered within Pillar 2 or not is defined based on your past. It has got nothing to do with your turnover this year. So even for whatever reason you are going to fall below 750 million this year, if your past 2 years are about 750 million, you are still within the scope for this year. Are we clear? Okay. So therefore, we had an interesting case where one of the client, So typical to UAE, there are lots of entities which are set up in BVI, Isle of Man, and all of those jurisdictions, and they have a branch here. But that parent entity doesn't do anything else except having that registration in that BVI or Isle of Man. Just because earlier we had only Sharia law and we never had common law, so they wanted a common law protection, and they went to one such jurisdiction, and they had 2 branches here. And of course, their turnover was way above 750 million, and they were into billions. And then they started getting worried that, okay, but we operate only in UAE. But I said, the way you are structured, you are an M&E group. So the only way for you to get out is before the rule applies, if you can either relocate your entity or re-domicile that to UAE and bring everything here. If you do that, then you are only a UAE operation. Then you might cross threshold, that's fine, but I am not then a multinational enterprise, right? Because I don't operate outside one country. So I said only way you can escape 10%, if at all, is that you re-domicile your entity back into UAE and make sure that it happens before the 25 kicks in, and so on and so forth. So I mean, these are the kind of thing that one needs to look at when you are starting to evaluate itself, whether it applies, not applies, what happens, and how it starts. And a lot of this were unintended, a lot of this was not something that the owners planned for it, but it is there, right? So that's one such example. Okay, so what are the excluded entities? Of course, the government entities are excluded, international organization, non-profit, pension fund, investment fund, that is an ultimate parent entity, or a real estate investment vehicle also can get excluded entity status. Once they are excluded, then they are not liable for the charging provision. Their income and taxes are not considered when computing the effective tax rate, and they have no administrative regulation or obligation to comply with the globe rules. So UAE government has notified a lot of their government entities, sovereign funds and all those. So I think Mubadala Group and the ADQ and some part of RDR are all nominated as government entities, but at the same time Dubai Investments and other are not. So there are different approaches taken by different emirates that we have. So again, we have to see how and where it applies, but if they are regarded as a government entity, of course, all of this will not apply to them. Right? Now, I'm not going to go into the detail of how do you compute and all that, but top-up tax is a mechanism that we ensure that M&E pays 15% tax. All the taxes which you pay and which you record in your financial statement as tax and deferred tax are all part of covered taxes. So deferred tax, there is a slight adjustment that we need to do, but just the examples here that I have included is the withholding taxes that you have paid, STTI that you will pay, or in Saudi Arabia if you have Zakat, it is again a tax on corporate profits, so it can also get classified as covered tax. Includes all domestic and foreign taxes and does not include any indirect taxes. So your excise, VAT and all of that are not taxes for the purpose of this calculation. Okay, because again those are, a lot of them are not your cost, it's passed on. So they will anyway not come in your tax expense, but even if they come in your tax expense, the stamp duties and all are not part of the covered taxes. Just for you to kind of relate. Deferred tax is included, but there is a specific mechanism because they allow the deferred tax computation only for a 5-year period. So you have to readjust your deferred tax working when you come to the covered tax, and of course my co-panelist will take that in detail. I'm not going to touch that part. Okay. So what does it mean? It means that M&Es you are operating in UAE will have to start preparing. Right? Now, you have to first assess whether you are M&E group, number one. If you are an M&E group, are you able to be part of any of the safe harbor or anything else? If not, then you need to start compiling your financial statements in the manner that is wanted under the globe rules. right? And of course, we'll go into that detail of how and what you need to look at. What are the data points that you need to start collecting? It goes much beyond your CBCR filing. So if you are doing already CBCR filing, don't assume that that's going to be sufficient. Because this data point that you need here are much beyond or way beyond the CBCR filings. So all that will also come in the next segment. So we have the UAE is already part of the qualifying domestic top-up tax regime. So whatever taxes that you pay in UAE will be part of your global computation for IRR purposes, and you will be able to offset in the UAE country's tax payment that you have made in your IRR calculation. And therefore it will in a way protect you from not having dual impact on having to pay in UAE and then also you go back and pay in your ultimate parent entity country. That's not going to happen. So that is fine. So that we are kind of shielded to that extent, as I would call it. But that's all. The protection that I talk about is only that much. It's not beyond. So you're either paying here or in ultimate parent entity, but it's that. And compliance, of course, you need to file the globe return in UAE for the UAE income. And then, of course, you need to prepare and file for the overall reporting at the IRR level for the head office as well. The same thing will go back to head office for their filing overall as well. These steps are for Jan and his team to take a look at and go into detail with you all. But I'm just giving you the stepwise process. You have to first define that you are in scope. Then you compute the pillar 2 income or loss, substance-based income inclusion, adjusted cover tax, effective tax rate, and top-up tax. Okay. International shipping is excluded. And therefore, there has been a lot of hue and cry from the airline companies that if shipping is excluded, why not us? And that is still not on the radar as far as we are concerned. OECD rules does not include that. So only shipping is currently part of the exclusion that they enjoy as a sector, right? These are some important provision on safe harbor that I want to kind of take you through, because these are some clauses which can, if you meet this requirement, then some of the compliances that we spoke of will not apply to you. So the pillar 2 rules have extensive safe harbor provisions. We have something known as permanent safe harbor. We have transitional safe harbor for first 5 years, and we have a simplified calculation of those also. And then we also have for first 5 years something called an initial phase of international activity exclusion. So these are 4 points that I just want to kind of bring it to your knowledge, and then you just keep it in mind that these are the threshold. If you fall in any of them, then again for the entities in UAE, the compliance will not trigger, and they'll deem the top-up tax to be 0. Okay, so let's start with the permanent safe harbor. 2 conditions, and both have to be met. If your revenue or average pillar 2 revenue for current and 2 preceding fiscal year is less than 10 million euros, and your average income is less than 1 million euro, or there is a loss. If you meet both this condition, then you are part of the permanent safe harbor, and you can exclude the UAE operations from the compliance. Please remember, when I talk about this all compliances, you have to combine all of your UAE operation. So if you have one entity in UAE, that's perfect. But if certain groups who have 5 or 10 entities in UAE, they'll have to compute a UAE financial and apply all these conditions at that level, and not at the individual entity level. So one is a permanent safe harbor, second is a transitional safe harbor. Again, the purpose is to give relief for some intermediary period of first 5 years, that if you are not yet ready, if you are still within a smaller scale of turnover, you get excluded from this entire onerous compliance mechanism that we have. Okay. So source has to be your consolidated qualified financial statement only. It cannot be anything else. And JVs are of course treated separately. Here we have 3 conditions. And if you meet either of the 3, you can still apply for being excluded. So first is of course the permanent safe harbor condition of turnover of 10 million or 1 million euro profit, or less of that. So that's of course there. If you meet that, you don't need to go in any of the others. The other is there is a simplified cover tax divided by the net profit before tax, and if it is below the transition rate. So for first 2 years, the transition rate are mentioned below, it's 16 and 17%. And if you are above that rate or equal to that rate, then you can still apply for a transitional safe harbor rule. Or you have a routine profit test where substance-based income exclusion, which there's a detail working on, which you will see in the next segment, is above your net profit before tax. So if you meet any of these three conditions, then you can still apply for the transitional safe harbor rule for first 5 years of introduction. So if it is from 25, we are talking of up to calendar year 30 that we can apply this to. There is also, because the computation here is slightly more evolved, there is also a provision to apply for a simplified computation for that. So these are some of the conditions attached to the transition safe harbor rules. So it has to be applied to fiscal year beginning on or before 26, but not including fiscal year after the June 28. So it's only for that 4-year period. In M&E group has not applied in earlier year, but if it becomes or comes within the globe rule only after that, then they can still apply for that period. Okay. Simplified rules are here to apply where calculations are simplified without altering the M&E group's globe outcome. Top-up tax will be 0, and simplified globe are with reference to the new framework that. So again, these are only for non-material constituent entities. It's for smaller entities only. It's not something that you apply generally for everybody else. Okay. Again, here you don't have to do a detailed calculation. Just look at the effective tax rate. Is it 15% or below? Is your substance-based income exclusion equal to or below your income? And if you have any of that too, you can still apply for the safe harbor rules. Okay. This part is of course very interesting, because in the original OECD rules, this is reserved only for implementation of UTPR. However, UAE chose to introduce and give it to general benefit for everybody under the main DMTT rules itself. So it is a beneficial provision which UAE has introduced to benefit a lot of its multinationals who can qualify within this criteria. Okay. So it allows smaller multinational group to avoid making complex globe calculation. Top-up tax will be deemed to be 0 and applies only for first 5 years. Right? What are the tests? We have 3 tests here. The parent company or the parent entity in the country in which that entity is located does not implement something known as the income inclusion rules. So as we discussed in the beginning, US, India, China have not implemented IRR or not implemented Pillar 2 itself. So if you are a subsidiary of an Indian company where India has not implemented IRR, and if you follow the other 2 conditions also or meet other 2 conditions also, then you can actually get out of the globe computation rules. Okay? So if your parent company in the country in which it is has not implemented IRR rules, if you do not have operation in more than 6 jurisdictions, so you should be only within 4 or 5 countries or maximum 6, and your tangible asset except the main all outside entity together be below the. If you meet all these 3 conditions, then you can apply for exemption from the computation of the globe rules. This is a beneficial provision. This is not there in the overall DMTT context. It is what UAE has chose to implement to benefit some of the M&E groups that are operating here. Are we clear? So just an example, if we have a parent company in BVI with a UAE 2 subsidiaries, and then they have Oman and Swiss subsidiaries as well. So overall we are less than 6 countries. BVI has not implemented IRR, and the tangible assets are less than 50 million. It's at 40, 45 million, and therefore we meet all the three conditions. So you can actually go and apply for exemption under the initial phase of activity exclusion. But if I change it to Isle of Man, with having Oman and Swiss company under it and having a UAE entity, Isle of Man has already implemented IRR, surprisingly. So if Isle of Man has implemented IRR, I cannot go and take this benefit for those entities and those structures, right? Just to highlight the differences for you. Now, in the last one, the BVI could have been easily in India. Okay, so you can juxtapose it or change it in the same way and understand the context from that perspective. We have the filing obligation, there is filing deadline, and all of that comes up. Okay, one more point which I have highlighted at different forums is that the intention for UAE was to implement domestic minimum top-up tax. What does it do? The framework for DMTT is basically to enable a country to collect the tax that would otherwise anyway be collected by some other country, right? Now, UAE implemented DMTT. What has happened today is that if I have a UAE-based multinational group, and if I am not meeting some of the conditions that I just mentioned, that I am operating in more than 6 countries, I have tangible asset of more than 50 million, I will still end up paying a 15% tax where no other country is going to collect that from me. So this is something which is very unique, which maybe it has overlooked, that this intention or this implication can come about. And I have, of course, tried to reach out to them that this is also there. Look at it, but nothing has come as yet. But this is one part that one must understand, that even if you have a UAE-based multinational, if you don't meet this initial phase of activity conditions of only 5 countries, 50 million tangible asset and all of those, you will also end up paying the domestic minimum top-up tax at 15%. And that's an unfortunate consequence of the law as it stands today. Okay, so my time is already up, but I'll just mention that yes, of course, your filing obligation, filing deadlines are quite a bit. So there is 15 months deadline after the end of reporting fiscal year, but for the first year, which is 25, we'll have time of 18 months. Okay, so we have time, but we need to start preparing, like Deloitte is already preparing to help their client do the things, so we also need to start gearing up. Again, this is just a broad level that you take a high level assessment, review all the things, and we or others can help, but that's fine. Thank you very much.
Thank you so much, Nirav bhai, for that brilliantly simplified sessions. And I think if I need to highlight one takeaway for these sessions, the pillar 2 is not just about that additional tax. I think it's about the additional transparency as well. So on Nirav bhai, we need you on the podium, please come back. So on behalf of the ICI Dubai chapter, sir, we sincerely thank you for your sharing your time and knowledge in your signature style. And this morning I request our chairman CA Jayaprakash Agrawal and CA Rishi Chawla, the vice chairman, to come forward to present a small token. And along with that, I would like to call my committee member Sanjay Gagrani ji, and along with that, I would like to invite Professor Sundar Rajan sir on the stage to do the honor and to present the memento. Can I have a huge round of applause for the speaker, CA Nirav Shah bhai. All right, so in the beginning of the sessions, I shared that, there is an iPhone to win, but now, yes, I just got updated. There is a Sony headphone as well, sponsored by the Windmill. So don't go anywhere till the end of the sessions. Right after the word of thanks, we are going to announce the winners and do the raffle draw. So thank you so much, Nirav bhai, chairman sir, vice chairman sir. He's already left. So up next, we continue our deep dive into the world of international taxations and its evolving ecosystem. So So we now move into the joint deep dive on the cornerstone of the pillar 2, the computations of top-up taxes, deep dive into the mechanics. That's our next topic. So expect an end-to-end walkthrough of the moving parts from the building blocks of globe income and cover taxes to effective tax rate, computations and how to top up crystallizes. So this is where the framework turns into the numbers, and to do the formal introductions of our next speakers, Mr. Jen Roderick and CA Bhumit Gangar, I would like to call our treasurer CA Ashna Mulgaonkar and CA Sanjay Gagarani. Can I have a huge round of applause for both of them? It's very low. Guys, please show your energy for XCOM.
Good morning. Today morning when I walked in, I saw a very sharp glow on the face of my committee members. I didn't understand what happened, why my face is dull and they are all glowing today. Then it realized, yesterday we were all fasting and feeding our husbands with lot of love. That's the glow that was glowing on their face today morning. You can laugh, please. Now coming back to pillar 2 today morning. What comes to your mind with pillar 2 and Karwa Chauth? Any similarities? Both require patience, disciplines, and complete transparency. While on pillar 2, the wife fasts all the day, hoping that her efforts will keep the relationship strong. With pillar 2 also, companies are fasting. For food? No. For loopholes. They are fasting for loopholes. They are waiting for that perfect moonrise moment. Companies across the world are waiting for that guidance, the final clarification, safe harbors, administrative reliefs, before they can finally break their fast on uncertainty. And just like the husbands, they also know they cannot skip the moon, the same way MNEs cannot skip 15% tax. Today, to hear more about technicalities, we have amongst us Jen Roderick. With nearly 2 decades at Deloitte, he has built a distinguished career specializing in international and M&A tax advisory. Currently serving as a partner in Deloitte UAE, he brings deep expertise in guiding multinational corporations, high-growth business through complex border technologies, restructuring, and compliance challenges. Jen's international journey across Europe, Asia, and Middle East has equipped him with a unique perspective on tax strategies that transcend jurisdiction, known for his client-centric approach. Without taking much of your time, let me welcome Jen. But before that, I would request our board member Sanjay to welcome our next speaker. Thank you.
Good morning, namaskar, salam. It's not about Karwa Chauth Ashna, it's all about because we all survived the first ever the UAE corporate tax filing season. If there was a time when the world return was having the more meaning, it was the last month, it was more than the investment returns. Between portal passwords and payment deadline, I think we can all now can say that we got an honorary degree from FTA troubleshooting. But good news is the storm has passed, the coffee machine now can take rest, and we can once again see the daylight just in time for Diwali. And as the diya being lit across the home, it's time for us to light another kind of the lamp, one called Pillar 2 compliances, the next big wave shaping the global tax landscape. It's about 15% global minimum tax, transparency, and ensuring that multinational enterprises pay their fair share when they operate. Of course, once you open the OECD guidelines, it feels like opening a Diwali gift. You start with excitement, but within 2 minutes, you are surrounded by top-up taxes, safe harbor rules, and global income adjustment. And that's why exactly we need someone who can simplify the complex, illuminate the obscure, and maybe make us smile while decoding these rules. We have just the person, CA Bhumit Gangar, Senior Manager Internal Tax at Deloitte Middle East. Mr. Bumit is a seasoned international tax professional, more than 14 years of experience across the UAE, Oman, and India. He has worked with clients in oil and gas, EPC logistics, shipping, and pharmaceutical, helping multinational groups designing tech efficiency structure while staying firmly within the boundaries of compliance. He has represented clients before the tax authorities, mentors team, turned even the decent OECD updates into something professional can actually relate to, a real skills indeed. As we approach to Diwali, the festival light over the darkness, it's a feel symbolic that we are here to understand Pillar 2, which is on way also promote light, light of fairness, transparency, and global harmony in taxation. So who better to illuminate the shadows of Pillar 2 than CA Bhumit, whose insights are sure to bright our professional path and maybe even compliance dashboard. So ladies and gentlemen, please join in warmly welcoming with festive applause to both our next speaker, CA Mr. Bhumit and Mr. Ian.
Good morning, everybody, and thank you for having us. Thank you for the kind introductions as well. So, as we've also went through the first UAE corporate tax filing season. We filed hundreds of returns, and actually, of course, by the end of September and on Thursday this week, I already had all of Deloitte's Pillar 2 champions across the region gathering in the UAE to discuss our approach to Pillar 2 compliance. So it was a fantastic day. And the motto was very much after compliance is before compliance. Yeah, we now have, we're sort of lucky to have almost 2 compliance cycles in one financial year. So we have the UAE corporate tax filing season, September, and then Pillar 2 compliance next year will be June, but then it will be March, because in the first year there is 18 months and then it's 15 months. So, you know, I think that's completely unprecedented to have, have 2 filing seasons within one fiscal year in that sense. Excellent presentation, Nirav. I think you've set the foundation very well. Just to recap on the most important things, right? So Pillar 2 doesn't apply to every company. It only applies to the large M&Es, and these are large groups with consolidated revenue or entities within those groups. And when I say within those groups, what I mean is entities that are consolidated on a line-by-line basis, or entities that are within the consolidated financial statements of groups that have consolidated revenue of more than 750 million euros, right? Now, that is the main, the primary condition that needs to be met. Now, the second step is if we then focus on the UAE entities within the group, right? Because we're talking about the UAE QD entities, so we focus on the UAE entities within that group. In principle, we then need to see whether the effective tax rate is 15% or not. So Pillar 2 really, it's all about paying at least 15% in each country where we have legal entities. So the question is always, are we above or below the 15%, right? So that concept of the ETR is super important. And how you calculate the ETR, that is all within the globe rules, within the Pillar 2 rules. So it's not how you normally may compute ETR for financial accounting purposes. There's a specific set of rules how you do that, right? Now, there are some safe harbors, and I think Nirav touched on it, but very broadly, and it's quite high level, but entities with, if you have minimal profits, minimal operations in a particular jurisdiction, more likely than not, you're not going to have a top-up tax, because we ignore these entities with limited profits or limited operations. But of course, in the UAE, more often than not, and assuming we have substantial profits in the UAE entities, the effective tax rate will be less than 15%. And that's simply because the statutory rate is only 9%, right? So in that scenario, of course, more likely than not, we will have a top-up tax. So we need to calculate the effective tax rate because we need to know what the top-up tax rate. So on a very high-level basis, and Bumit is going to talk about what are covered taxes, what is global income, because that will give us the effective tax rate for the UAE. Once we have the effective tax rate, we can then establish the top-up tax percentage, which is the 15% minus the effective tax rate. We also need to determine excess profits, which is basically global income less a substance-based income exclusion. On that basis, we can then calculate the top-up tax, which is the top-up tax percentage times the excess profits. So we'll go through this in more detail. Now, just from a practical perspective, right? So what is driving the ETR within this equation, right? So, of course, the more elements you can include in the covered taxes, so in the denominator, the higher that amount, the higher, of course, your ETR, right? Now, of course, in the UAE, all we can include is the UAE corporate tax, but in other countries, you can add additional taxes which are equivalent to covered corporate taxes. On the other hand, the lower the global income, the higher our ETR. So are we making sure our global income is correct? Then, of course, the substance-based income exclusion. That's a bit similar to what we have in the UAE. So in the UAE, for corporate tax purposes, the first $100,000 are not subject to corporate tax. So it's a relief. It's a certain amount that is just not subject to tax. The concept of the substance-based income exclusion is a little bit similar. The difference is that we calculate this amount based on payroll and tangible assets. But can we optimize that amount? The higher the substance-based income exclusion, the lower my excess profits, right? So I think these are the levers within this calculation that we have and that we also can play with, and from an advisory perspective where we would come in and say, have you considered all of your payroll costs? We'll talk about what that is because it's quite broad. Have you considered all of your tangible assets? Can we include ROUs? So all these type of questions, that's where we can, of course, add value, maximize these amounts, which of course will then reduce the top-up tax that you have to pay. So with that, I hand over to Bumit to go through global income and loss.
Thanks, Jan. So as you can see on the screen, there are 3 computations. And with Pillar 2, of course, you will have one additional computation, which is the third computation where, similar to corporate tax, you start with profit after tax, and then you start making adjustments similar to corporate tax. There are certain adjustments which are similar to corporate tax. However, there are certain adjustments which are new and different, and therefore, there may not be alignment or complete alignment between the corporate tax and Pillar 2. After making the adjustments, you arrive at the globe income and the denominator which of the formula of ETR which we just spoke about. Yeah. So you can see on the screen, this is the exhaustive list of adjustments that we make to profit after tax to arrive at globe income. There are certain mandatory adjustments which you have to make. There are certain adjustments which are based on elections, which means these are optional. Only if you make election, then only you make those adjustments. And there are some other adjustments such as TP adjustments and qualifying refundable tax credit, and we'll just talk about them in some time.
Maybe just one observation, right? If you go We don't have to go back. But as Bomit explained, for corporate tax, we have our own computation, we have our own separate tax base. And for Pillar 2, we have a separate tax base as well, right? And of course, they're not exactly the same. And I think what we can say is that more often than not, the UA tax base for corporate tax is broader. Why? Because there are additional add-backs, entertainment expenses, interest which we can't claim, whereas the Pillar 2 tax base is more aligned with accounting and doesn't have these additional add-backs that we have for corporate tax. Now, if you think about this, okay, so our corporate tax base is going to be broader than the Pillar 2 base. That also means that my ETR is probably not going to be 9%. It's going to be higher, a little bit higher, right? Not in all cases, but probably a little bit higher.
So coming to the starting point of this computation, you start with net income or loss, which is determined for a constituent entity in preparing the consolidated financial statements, but before making the consolidation adjustments. So Globe rules say that you start with the consolidated financial statements. However, when you look at the UAE QDMTT law, it says that you have to use the standalone financial statements, wherein you start with your net profit after tax, and then you start making those adjustments. Now, what are these adjustments? So let's go in some of the important adjustments in detail. First and foremost, net tax expense. So because you start with net profit after tax, you start making adjustments for the taxes that you have accrued in your financial statements. This not only includes the corporate tax that is accounted in your financial statements, but also the withholding taxes which are accounted above the line item in other expenses. So let's say if there are withholding taxes which are accounted as other expense before tax, then those also needs to be adjusted to arrive at the profit after tax. As Neerav already pointed out, deferred taxes are also one of the important factor in computing the globe income and the cover taxes. The deferred taxes which are accrued in the financial statements, you need to adjust them as well. So for example, if there is a deferred tax liability which is considered as a net tax expense within the financial statements, then you need to add it back. And if there is a deferred tax asset that is recorded, then you need to deduct to arrive at profit after tax. Profit before tax, sorry. Not only the current tax or corporate tax that you need to adjust, but also the taxes which are accounted for domestic top-up tax, UTPR, IIR, etc. Those also need to be adjusted. So these taxes which will now come in the financial statements after 2025 will also be adjusted to arrive at profit before tax. Second important adjustment is excluded dividends. So similar to your corporate tax, we have participation exemption in Pillar 2 as well, where if you have investment of more than 10%, so in corporate tax we have 5% threshold, whereas under Pillar 2 you have 10% threshold. So if let's say you have investment of more than 10%, then dividend coming or dividend earned from that entity will be excluded, which means there will not be any top-up tax on that. You will deduct it from your net profit after tax to arrive at your globe income. Here it is important to note that in case you have less than 10% investment, but if you are holding that investment for more than 12 months, still it can be excluded. So it is not necessary that you have investment of more than 10%. Even if it is less than 10% but held for more than 12 months, then the dividend coming from that investment is also excluded.
So in that sense, the participation regime under the Pillar 2 rules is more generous, right? And then, of course, you could have a situation where you might be paying corporate tax on dividends, but not for corporate tax purposes, but not under Pillar 2. But I think we have an example on that later on.
That's possible. And also, the subject to tax requirement which is there in the corporate tax is not there in Pillar 2. So it's possible that you are not meeting subject to tax requirement under corporate tax, but still you have excluded dividends under the Pillar 2 rules. There is a 5-year election available where, even though the dividends are excluded, you can include them into the computation. Now the question is, why would somebody include dividend when the rules are giving an exclusion? The simple answer is that if there is a withholding tax on dividend, generally if you exclude the dividend, you have to exclude the corresponding withholding tax as well from covered taxes. But if you want to include those withholding taxes into your covered taxes, then you can make this election and include the dividends on short-term portfolio dividends, and then you can increase your ETR. So it will all depend on how much withholding tax you have on your dividends, and accordingly you can make this election for including the dividends. Next adjustment is excluded equity gains. So similar to, again, corporate tax, if you have investment of more than 10%, then disposal of such equity investment will be excluded from the computation of globe income. Here it is important to note that even if you are holding that investment for less than 12 months, but if it is more than 10%, then the equity gain is excluded. So unlike dividend where you have investment of less than 10%, but if you are holding it for more than 12 months, the dividends are excluded. Here there is no such concept, so holding period is irrelevant here. And if you are holding it for even for 12 months or less than 12 months, but if the investment is more than 10%, then the equity gains are excluded. Now, when we say excluded equity gains, what all elements are excluded? One is changes in fair value. So let's say if you have an investment of 12% and you have booked certain unrealized gains based on fair value method of accounting, then those unrealized gains will also be excluded under the excluded equity gains. Second is equity method of accounting. So let's say if you have investment in associates, joint venture, etc., and you are accounting them on equity basis, then the share of profits that you account in your financial statements will also be excluded under excluded equity gains. And the last one is, of course, the disposal. So actual disposal of investment, the gain on actual disposal or the realized gain will be excluded. This you already covered. Some of the elements which are not included is if you have less than 10% of shareholding, then the fair value is not excluded here. There is another adjustment which we'll talk about where you can exclude those fair value changes for shareholding where the investment is less than 10%. There is an election available again here as well where if let's say you hedge your currency risk on the investments, then the hedging gain can also be excluded along with your excluded equity gains. Just to be kept in mind that only effective hedge portion is excluded and not the ineffective portion of the hedge is excluded. So you can make those election and cover this hedging gain that you have on your instruments. It is important to note that only currency gains or currency hedging is included. If you make a hedge instrument on the investment itself, then gain or loss on those hedging instruments are not covered here. So just an example here. Let's say there is a company A which has an investment in UK of 8%. Now, as per the rules, because it is less than 10%, but if you are holding this investment for more than 12 months, then the dividends coming from company B to company A will be excluded in the hands of company A, right? And if you look at the right hand side of the screen, because the investment is only 8%, and if you dispose of company B's equity shares, even if you are holding it for more than 12 months, but because it is less than 10%, it will not be excluded. Now, if you compare it with your corporate tax, because the investment is more than 5%, and UK being a high tax country, you will also meet the subject to tax conditions. So in that sense, the equity gain and dividend both will be exempted. However, there will be a different scenario under the Pillar 2 rules. There are certain other adjustments as well. So first and foremost, TP adjustments. So let's say if there are cross-border transactions and these transactions are not carried out at arm's length, then you have to make TP adjustments even for Pillar 2. So this is an adjustment that you have to make out of the books. So let's say in your financial statements you have recorded transactions which are not at arm's length. You have to make an out of the book adjustments to arrive at the arm's length price. Second is QRTCs, qualifying refundable tax credits. These are defined within the law. So certain tax credits which you receive from Federal Tax Authority, and if they are qualifying as per the definition given in the law, then these are included as part of your globe income, and they are also included in the cover taxes. We'll talk about that. This will help you in increasing your ETR even though you receive a refund of taxes from the government.
Maybe just to add, so I think the Ministry of Finance has announced that they will introduce tax incentives, I think starting from next year, which will be good incentives from a Pillar 2 perspective, meaning they should qualify as a QRTC. And of course, once a company applies for such a refund, then of course, under this rule, you would treat the refund as additional income as opposed to a reduction in your covered tax, and that has a better impact on the effective tax rate calculation. And that's what we're seeing globally. Singapore, for example, has recently introduced an investment credit, investment credit, but all countries are now looking at implementing these type of credits, which are qualified credits, where this treatment would apply.
And it is very important that all the free zone entities which are currently enjoying 0% benefit, they will all be covered by top-up taxes, so they will have to pay 15%, and which is where these QRTCs will come in as an incentive for businesses to invest in the UAE. Certain election-based adjustments. One of the important adjustment is realization principle for assets and liability which are accounted on fair value or impairment basis. So similar to your corporate tax under Article 20 where you make adjustments for fair value adjustments. So unrealized gains and losses on some of these assets can be excluded by making an election. Unlike corporate tax, which is an irrevocable election, this is a 5-year election. So after 5 years, you can go back to unrealized basis of election, but otherwise there is an option available here as well. Another important adjustment.
Maybe just a comment on the realization basis election. And of course, if you think about the genesis of the UAE corporate tax law, but when these two regulations were drafted and issued, there was overlap, because technically the globe rules came out first and then the UAE corporate tax law, but of course, and therefore the question is, okay, to what extent was the UAE corporate tax law influenced by the globe rules and vice versa? If you look at the realization basis election, if you look at the wording, it's exactly the same. So the wording that you can find in the corporate tax law and the guides, and the wording that you can find in the globe rules and in the commentary is exactly the same. So they have been adopted that basically from the globe rules.
Yeah. One of the other important adjustment could be aggregate asset gains. So let's say if you're selling certain immovable properties and there is a huge gain, no need to pay top-up tax in the same year. You can carry it backwards for 5 years and spread it across 5 years to make the payment of top-up taxes. So next up, let's talk about adjustments to cover taxes. Similar to your globe income, you have to start with income tax expense that is accrued in the financial statements, and then you start making these adjustments. So one of the important adjustment is, of course, the deferred tax. You not only consider the corporate tax payment that you have made and accrued in your financial statements, but you also consider the deferred tax assets and liabilities to adjust your cover taxes. There is an important rule which is called recast rule. So if let's say deferred taxes are accrued at less than 15% or more than 15%, you have to recast them all at 15%. So let's say in UAE's case, if there is a loss in an entity and you have accrued a deferred tax asset of 9%, you can recast it to 15%. so as to get the benefit in the subsequent year when you set off the losses and you reverse your deferred tax asset. What else? So there are certain adjustments, cover taxes which are accrued in the OCI. So if, let's say, while computing the globe income, you are considering certain part of OCI as well, then the deferred taxes and the current taxes which are accrued within OCI are also considered as cover taxes for globe income for top of taxes purposes. Certain exclusions, one of the important exclusion is UTP, which is your uncertain tax positions. So let's say in the financial statements, if you have or auditors have classified certain tax provision as uncertain tax positions, then those are excluded, which means you cannot inflate your current taxes by making accrual for these uncertain tax position. You have to exclude them, which will reduce your cover taxes. However, let's say in the subsequent year, if these uncertain tax positions are realized, which means you make payment of actual taxes against these uncertain tax position, then these are allowed in the year in which you make the payment. Certain taxes which are not covered, I think Neerav already covered this. Some of the taxes which are levied based on income, such as sales tax, excise, etc. Digital service taxes, which are again levied on income basis, are also excluded. Payroll taxes, and of course, all the Pillar 2 taxes, QDMTT, IR, UTPR are not considered as cover tax, so you cannot consider them as part of your numerator. Certain basic principles. So let's say if you are excluding some of the income from globe income, then corresponding taxes also needs to be excluded, and that's a general principle across the rules. Withholding taxes on dividends. Let's say there are withholding taxes on dividends that is received from a constituent entity, which means, let's say if you have a subsidiary of more than, where you have investment of more than 50%, and you are consolidating that subsidiary into your financial statements. Let's say if you are receiving dividends from such subsidiary, then the withholding taxes on dividends will be allocated to the entity which is paying the withholding tax and not the entity which is receiving the dividends. Whereas in case where you have dividend received from a non-constituent entity, then the withholding tax will be allocated to the entity which is receiving, which means the entity which is receiving the dividend will consider them as part of their ETR or the cover taxes in the numerator. Similarly, for withholding taxes on royalty, fees for technical services and other services, these withholding taxes can be considered as part of your cover taxes so as to increase your ETR. So just a summary of certain deferred tax adjustments. Let me load the slide. So as I mentioned, if let's say tax rate is less than 15%, you recast them to 15%. Let's say the corporate tax is 25%, therefore you book your deferred taxes at 25%. You recast them to 15%. Similarly, if the rate is lower than the minimum rate, which is 15, then you recast it to 9%. Similarly, for losses, if you have, let's say, deferred tax, if you have to create deferred tax asset, you can recast it to 15%. Now, in some cases, auditors do not allow us to record deferred tax asset because the recognition criteria is not met, so on and so forth. Still, the globe rules say that even in those cases, you can consider a 15% deferred tax asset on the losses. The recapture rule, one of the very important rule in deferred tax adjustments is that if you create a deferred tax liability on any of the items, and if that deferred tax liability doesn't reverse within 5 years, then globe rule says that in the 6th year you have to mandatorily reverse it, which means you will reduce your ETR by reversing the deferred tax liability. However, there are certain exceptions to these recapture rule. For example, if there is a deferred tax liability booked on depreciation, difference in the depreciation between the corporate tax and the financial statements, then you don't need to reverse them within 5 years. You can continue to carry it forward for more than 5 years. Similarly, if there is a deferred tax liability which is booked on, let's say, realization basis of principal, and if you are ignoring the fair values, then the deferred tax liability can be continued to be carried for more than 5 years. And you don't need to apply the recapture rule to reverse them mandatorily. Substance-based income exclusion. So we saw in the formula, top-up tax percentage is applied not on the globe income that you compute, but it is applied something known as excess profits. So excess profit is nothing but pillar 2 income, the globe income which we calculate by making the adjustments, less some of the substance-based income exclusion. And what is this substance-based income exclusion is certain percentage of your payroll cost and your tangible assets. So it starts with 10%, and then it goes on to reduce to eventually become 5% each, for 5% on payroll cost and 5% on the tangible asset, which will be reduced from your globe income to arrive at the excess profit. So top-up tax is only levied on the excess profits. Certain elements of payroll cost, not only salaries and wages, but you can also include the pension, stock-based compensation, payroll taxes paid by employer, etc. These are also included in the payroll cost when you compute the substance-based income exclusion. Other important criteria is that, if let's say there are certain contractors which are not your employees, but which are working under supervision and yours, then you can still consider the cost of those contractors as part of your payroll cost. It is important to note that when you're considering the payroll cost for substance-based exclusions, the employee should be in the same jurisdiction. So let's say if you're computing substance-based income exclusion for UAE, then payroll cost should be for the employees which are working in UAE. If let's say they are traveling and working outside UAE, then you'll have to see how much time they spend outside UAE. If they are spending more than 50% time outside UAE, then you'll have to only consider the pro rata basis, which means if let's say only 30% is spent in UAE, then only 30% of the payroll cost will be considered for substance-based income exclusion. Whereas if they are spending more than 50% within UAE, then you can consider the whole payroll cost for the exclusion. Tangible assets, of course, your plant, property and equipment you can consider for your substance-based income exclusion. Also the assets which are acquired on lease basis, where you are considering to record ROUs in your books of accounts, you can also consider those assets into the tangible assets carve out for the purpose of substance-based income exclusion. There are certain elements such as investment properties. In certain cases you can consider those as well. I'm not going into the details, but it is to be noted that even investment properties in some cases can be considered as part of your tangible assets. Again, similar to employees, if your assets are mobile, then if they are outside of UAE, then you have to consider the pro rata condition similar to employees. If they are more than if they are present for more than 50% of the time in UAE, then you can consider the full tangible asset for the carve out purposes. Yeah, so we already considered all of this. Top-up tax is nothing but top-up tax percentage into the excess profits minus the domestic top-up tax. So in some cases, let's say if the top-up tax is not a qualified domestic top-up tax, then you have to adjust it in this formula and arrive at the top-up tax. Whereas let's say if the domestic top-up tax is a qualified one, then of course there is a rule that switches off the top-up tax. So the IIR countries will not be able to collect any tax in case your domestic top-up tax is a qualified one.
And maybe just as a final comment, right, and referring back to the title of this event, which is the journey from 9 to 15%. Now that's not completely true, right? So number one, this 15% only applies to large M&Es, right? And even if you are an entity of a large M&E, if you meet safe harbor, if you have small profits, you might not actually have a top-up. But even if you have a top-up, so you have substantial profits, then the substance-based carve-out can be quite a significant amount, which of course will reduce your tax base. So ultimately, your effective tax rate will not really be 15%. It will be somewhere between 9 and 15, depending on your facts and circumstances. Thank you very much. Well done.
Thank you so much, Ian and Bhumit, for that brilliant, I would say, brilliant technical walkthrough. And the key takeaway was, I think, also clear. While Pillar 2 computations may look intimidating on the paper, but once you understand the logic behind the global income, cover tax and effective tax rate, it's less about the numbers and more about ensuring fairness and consistency across border, right? So thank you so much once again, Ian and Bhumit. And now I would like to call our chairman, CA Jay Prakash Agarwal, treasurer Ashna Mulgaonkar, and our EXCOM member Sanjay Bhai is already left. And along with that, I would request CA Prakash Nair sir on the stage and to present the memento on behalf of all the members and the committee. Can I have a thunderous round of applause for these two stalwart speakers, please? Thank you once again to our speakers for that deep and the insightful sessions, and thank you Prakash sir as well. And we now move from the computations to the applications, from understanding how the top-up tax is calculated to how organizations are actually preparing to live with it day to day. So our next session is about it's the perceptions of the businesses, and to do the honor for the next speaker, I to formally introduce the next speakers, I would like to call our board member, CA Balram, to do the honors and to introduce the next speakers, please. It's very silent. Can I have a huge round of applause for our board member, CA Balram?
Thank you, Amit. Good morning, ladies and gentlemen. Way back 20 years, about 2006, when I moved from India to Dubai, though I moved to Big Four from here, the kind of weightage that is given to the audit reports and the kind of importance given to the auditors was a kind of a shocking thing for me. It was about 20 years ago. But fast forward 20 years now, if you see, because of these various compliances and taxes, we see good amount of weight is given to all the professionals in finance, as well as to auditors and audit report. Though there is a little bit burden on the businesses to comply with, but it is a welcoming thing for all of us as chartered accountants to see all this. So one such opportunity and topic is about Pillar 2 as well as global minimum tax. I think it is going to be another opportunity for all of us. Moving on, our next speaker is a seasoned tax leader with a wealth of experience spanning over 2 decades. Mr. Rahul Babe is Executive Vice President and Head of Taxation at G Entertainment Enterprises Limited. A chartered accountant by profession, Rahul has over 23 years of rich experience across Big Four consulting firms in India and the Middle East, as well as leadership roles in sectors such as media and entertainment, oil and gas, EPC, and chemicals. He has been at the forefront of steering organizations through complex taxation and regulatory landscape, bringing together technical excellence and business strategy. His expertise covers IFRS, Ind AS, cross-border structuring, transfer pricing, M&A, and due diligence. Rahul is also a respected thought leader and frequent speaker at leading finance and tax forums, known for turning complex tax concepts into practical business insights. Ladies and gentlemen, please join me in welcoming a distinguished professional and strategist, CA Rahul Babe.
Okay, good morning. Good morning, thanks Balram, thanks Chairman, ICI Dubai for inviting me, and I would also now try to give a perspective. Nirav in the morning has already done Ashiki 1, and the Deloitte team also has done Ashiki 2. Now let me see if I can do a Sayara over here. So already, most of things are already covered. So I think people will think it's a repetition, but I'll try to see if I can give an industry perspective over here. Before I start, being a listed company, my views are personal and may or may not be part of my management or the company. That's a disclaimer which we want to give with. Let me just step back. Let me just step back a minute. So when I did my articleship, I did all my 3 years articleship in taxation. I have never done audit. And just now, like Nirav mentioned, you need to unlearn everything. I have to go back now and do Ind AS and IFRS again, which I have not done in my life. And as they say in Three Idiots, when Amir Khan was sitting in a movie, in a class where they were teaching how to learn machines, and machines kya hai, he was very happy. And that's where I was, learning about all the structuring. I was not more interested in domestic tax, more to do with the structuring across the globe. And this is what we created as an animal. And before this, also I want to step back a little bit and go to a period of 1980 to 2000, wherein the borders were all porous. The borders were all open. Everybody was going from anywhere to anywhere. Investments happening rampant across the board. And that's where the European Union created those animal structures. Double dip structures, triple dip structures. I don't know cooking myself, but I love to do these kind of structures, wherein a same structure, a same kind of capital would result into more deductions at a parent company level, at a subsidiary level, a holdco level, a opco level. I think these are something animals we only created. And unfortunately, as institute, as a chartered accountants, we have created our own grave. I mean, sorry to say that, but we have gone somewhere overboard. We created an animal, and we have to ride the tiger, and now we don't know where to stop. And that's where Pillar 2 has come in. And I want to make it more interactive, so I want to invite comments also from people. People out there who are there below 30s, and people who are there above 40s. Please give comments, because there is something important. And as professionals, we should first believe ourselves that we are not cost centers. We are all profit centers over here who are enabling the business and contributing to business. Do we believe all this? Everybody believes? Very good. So the moot question is, did we go overboard? Did we create these structures? And the aspirations of Europe are somewhere now haunting us, because the treasuries, the coffins are all empty, and now that coffins have to be filled with Pillar 2. There are countries like India, US, China who are opposing it, and rightly opposing it, because I think 8,000, 9,000 crores contribution to the GDP doesn't make sense for India. We are much ahead, right? So Pillar 2 doesn't make sense for us. We even don't want to get it. I think this famous book, everybody's aware of this book, Who Moved My Cheese? Right? 4 mice were there. I have 5 mice over here. And they all have moved the cheese. They're all in the maze, hunting for their cheese. And cheese is a metaphor over here. Metaphor towards what they want. First, the EU started with those structures, investment structures. Greece went for a toss. Netherlands, Hungary, Dutch Corp, Dutch investment company, making investment to UK, US. All those structures were created. Then OECD came. Very good. We all have created this. Now we can't do anything. Come, let's bring Pillar 2. Industry doesn't know. Consultants will come, give a structure. Industry, you take a call, because there is a disclaimer. I don't want to get into that. There are 4 options. Please go and implement. Right? This is where industry is getting caught. Then comes society. Who society? You and me, consumers, who are spending money. And we think that we are not getting employment because the revenues are being shared by some other countries. And consultants, obviously, everybody wants to, no hard feelings, but everybody wants to make the money in this game. And hence, that cheese, which is a metaphor, is also important for the consultants as well. Okay? Any point over here? Anybody who has to share anything? I want to make it very interactive. I don't want to be monologue over here. Please. I have my fellow colleagues who are ex-Big Four working in Dubai. Bhumik is there. Purvi is there. Akshay is there. So, but any point you guys want to share, happy to hear. Again, it's a repetitive. This is again Ashiki 1, Ashiki 2, but I have to give some perspective here as well. And before I go to even, one sec, this also we have done. I'll come to here. Before 9%, there was no tax in Dubai, right? I have worked in jurisdiction like Oman, where there were already taxes since, I think, 2004-5. and more tax was to do with PE in Oman. Dubai introduced this 9% tax in somewhere in 22, 23, and I think there is some significance with the date of 9 December. I don't know why. 9 December, twice the tax has come in Dubai. Any idea? I'm not sure why 9 December is the critical date for the decree to be passed. So, having said all this, UAE is still an attractive destination for investments, and we'll come to that when we look at R&D and some payroll benefits over here. But this is something which is going to affect everyone. May not be in India, but obviously in Middle East, where people will have to invest into, look at these structures and try and see how we can unwind those structures. So some of the readiness aspects which we have to look at is UAE domestic companies, right? Where they are all promoter-driven companies in UAE, those are all out of the structure, right? Am I right in this, interpreting this? Promoter companies are all out. Structures such as joint ventures or constituent entities will all get covered. Whether one partner is covered under Pillar 2, other partner is not covered, those all get covered. So you'll have to look at those structures. You will have a legal entity structure. You will also have structures which are unincorporated legal entities, which are somewhere called as a consortium arrangements. Those also will get covered over here. Then you have UAE headquartered companies who have operations across the globe. Even those will get covered. The permanent establishments in UAE, let's say for example, Shell is having some operations in UAE as a permanent establishment. Even those will get covered. Main point is over here, you need to look at your contracts. Are you having any tax sharing contracts with your joint venture partners? Those contracts have to be looked at very minutely because this is something which is going to affect everyone. Okay? I think Deloitte team already has covered this, but I want to just touch base about some of the readiness which we need to have from a data perspective. And these are more like IFRS adjustments which you need to look at. And this is all exhaustive data is there. So you need to have a technology in place to basically map this data and to see that the right computation is done when you do a Pillar 2 computation. And some of the main points over here is again to do with the forex gain and losses, the investment structuring, the debts which are there in the books, the stock option accounting and all that stuff. That has to be looked at. Now, key challenges for MNEs over here. One is how do you get the data? It's such a massive data. If you are having some minuscule operations, you should be able to manage. But it's a large conglomerate. Then how do you then see those data, interpret those data, and try and see how it's going to affect the overall computation of your organization as a whole? Also, in terms of applicability, it may not apply in UAE as of now immediately. Maybe it's in Q4 of FY26, which will have implication. But there could be jurisdictions across the globe which are already implemented in terms of, let's say, UK. UK is already covered. South Africa is already covered. Some of the EU nations already covered. So those computations also have to be done, and those have to be factored in as part of your provision for Q3 and Q4 or Q2 as the case may be. So this financial year 25-26 is something where you need to capture all this data and see how the numbers are going to be shaped up. So they're going to have a significant impact on your ETR. And if you are a listed player, then obviously the ETR is something which is a concern to all the investors, and you need to have this computation in place. Again, this is a significant aspect from a governance perspective. What is Pillar 2? Pillar 2 is giving a fair share to each country, right? And in terms of global reporting, if the reporting is not proper, obviously there'll be reputational damages. And who wants reputational damages over here? Nobody wants, right? Everybody wants to report something which is proper. There should not be any misstatements in reporting. The computation should be fair. And obviously, if you're preparing a tax transparency report, this will well capture all this data. And that is something which the ESG investors will look at when you prepare these kind of statements. Right? Also, when you do an interaction with the local tax authorities, wherever you have those in regime, you need to see how you can mitigate some of these issues in terms of your unwinding of the structures, where you have complex structures which will create more exposure in terms of tax outgoes. Look at the supply chain once again. Look at the marketplaces. Realign your transfer pricing in such a manner that it's making a commercial sense to do the transaction, and also it's not going to evade any taxes. Any thoughts over here? Anybody? No? No thoughts? I think silver lining over here is it's going to give a level playing field to everyone, all the industry players, and it is not something like one corporate is going to pay less tax, other corporate is going to pay more tax. Everybody will be at par, depending on the stage at which the corporate life cycle is, right? That is something much more important, and this will give a complete transparent picture to all the global investors who are investing in any company. I think these are some of the red carpet which Dubai is going to roll out in terms of R&D and payroll tax. R&D is something which we all saw in the EU, right? We had a lot of investments done by pharma companies, the IT companies, and there were SOPs given for R&D cess. Obviously, these credits will be taken as a part of the computation when you do look at the ATR calculation for Pillar 2. But this is something which will try and see if we can look at investments in terms of software, AI, pharma, agriculture technology, something which UAE should be a designation, should be a destination which has proximity to India, EU, and the US. I think this is something we should look at, and this will be a game changer as far as investments are concerned. Payroll tax is like you have all your C-suites employees who are working in Dubai, right? A lot of employees who are basically at a senior management level and earning in I think the carry income or more income in terms of their compensations. I think that's something, a benefit will be available over here. And I think that incentive is going to be rolled out from Jan 1st, 2025. So this is something we should look at when you make an investment. I think the moot point I want to make over here is tax is not going to drive investments. Please, commercial rationale has to be the base on which the investment has to be driven. Why you are making an investment in a particular jurisdiction should be based on the commercial rationale, not on tax. Tax is secondary. We'll come to tax later. I think way forward is we are in a fragile environment, right? The geopolitical situation is extremely fragile. The world today is sitting on a debt of almost over 300 trillion USD, and it's a bubble which is going to burst at any point of time. There are tariffs coming in. US is, I think yesterday also imposed some 100% tariffs on China, which is going to have a major implication as far as the entire supply chain is concerned. And looking at this scenario, I think we should look at how do we structure our entire transactions I would say Pillar 2 should keep it aside, mainly from a tariff perspective. Where are you going to park your profits? Is your marketplace going to define your profits, or is your structure going to define your profits? That is a moot question which everybody wants to answer over here. If I am selling my goods in EU, can I have my structure in Singapore? If I am selling my goods in the Middle East, can I have a structure in Africa or Mauritius? No. So that's the whole point. Where is your marketplace? Is your associate enterprise getting enough remuneration from a marketplace perspective? Are your structures in such a manner that there is fair share of profits distributed to the countries where you're actually operating, and these are not paper box companies? That is something we need to answer ourselves. I mean, everybody has a car, everybody has a tubeless tire. A tubeless tire, if it gets punctured, that tire will go on for say 100 kilometers, but then you have to anyway get it done, right? So don't look at short-term fix. Go for a long-term solution over here. And that solution should be in such a manner that it is a flexible solution. You don't have to redo everything, but you can do something which can basically change the structure in which you're operating, right? Anything over here, anybody has comment? No comments? I mean, no tax. I said it's all acronyms for fragile, world in which we are all living, right? It's all terminologies which come in on the internet. We started with hookah, we moved to Bani, we went to Ruta, but it's a brittle world in which we are staying currently, where economics are taking a back step, the political vendetta is getting more in terms of oil prices, in terms of the way AI is playing today, in terms of the way the tax revenues are coming today. I have seen jurisdictions like Mauritius now issuing rampant notices, and the disallowances are made like without any substance. So this is the situation in which we are living. And I have never heard Mauritius, a country like Mauritius issuing notices, right? Tomorrow we will see this in Dubai as well, right? In 4-5 years down the line, where the oil revenues are depleting, and the Brent is right now $60-65 per barrel. Tax is the only option where they can collect the revenues. No other option is there, right? So that delta is something which is going to come from us only. Okay, so look at UAE as a destination more from a non-tax advantage. Don't look at tax as a leverage for you to look at something like this. Look at UAE from a more business hub perspective. Set up your technology centers over here. Set up your pharma centers over here. Set up your operations in such a manner that it will boost the country, the revenue of the economy as a whole, rather than trying to take an advantage of 6%, 7% here and there. That's it from my side. I'm not going to put more over here. The reason being it's already covered as a part of first two presentation, but it's an industry perspective I want to give it over here. Thank you.
Thank you so much, sir, for that eye-opening sessions. And I would say, basically, Pillar 2 were a machine. I think Rahul Barve is the person who knows exactly that which bolts needs to be tightening. And sir, you have given that Ashiki 1 and 2 example, but based on your session, I can definitely say that when the Ashiki 3 will come, I assume that that's going to be a blockbuster like your session. So can I have a huge round of applause for Rahul Barve, and I request our chairman, CA Jayaprakash Agarwal, and our board member, CA Balram, is already here, and along with that, our former chairman, CA Surendra Jain sir, to come on stage and to do the honor and present a memento to our speaker. Whenever we are presenting the memento to our speakers, I want to hear that round of applause continuously. Thank you so much. Once again, Rahul Barve for that insightful sessions. Now, as we move ahead and we shift gears from systems and implementation to the strategy and compliance. And because once the computations are done, the real challenge begins, the reporting them accurately and complying with the evolving global standards. So our next topic is top up on multinationals reporting and compliance. Dives right into that space where numbers meet narratives and where tax policies translates into the disclosures that boards, auditors, and regulators all watch closely. And to formally introduce our distinguished speaker, may I now invite the young, dynamic, and energetic CA Dikshit Jain to do the honors. Please welcome him with a warm round of applause. So please welcome, he is already here to introduce our next speaker. Over to you, Dikshit.
Good afternoon, everyone. Can I have a louder good afternoon, please? I did not sleep the whole night. I landed at 5 o'clock in the morning from London, and I'm right here to introduce the speaker. So I think I deserve a better good afternoon from all of you. Thank you. So today's session is all about talking about how we are moving from the journey of 9% to 15%. But I think the journey we all know, the destination we all know. But there was once upon a time, not too long ago, when someone said there's a tax which is going to come into UAE, we would have smiled and said, what's that? Never heard about that. Then came the corporate tax, 9%, and we thought, okay, it's fine, 9% is not bad. We were all okay with that 9%. But just as we started understanding taxable income, transfer pricing, and those magical letters CTN, OECD decided to spice things up. And they said, congratulations, UAE, welcome to Pillar 2, the 15% Global Minimum Tax Club. And that's the journey, we are going to experience very soon. Think about those times, like we are upgrading from a Knoll card to Apple Pay. Same journey, but now with more checks, balances, and few more compliances cost. So fasten your seat belts. You are going to have some good time as a professional because we are already very, very busy. I'm sure everybody had a sleepless nights last few months filing those corporate tax returns. So it's going to be a great time for all of us as a professional. And as a chartered accountant chapter, we are trying to make everybody aware about new regulations and rules, and also thanks to my entire committee chairman for organizing this. Now today we have a speaker who is multi-talented, multinational, worked in like 40 countries in 18 years. So I was just thinking how a person in a one lifetime can work in 40 countries in 18 years. He is a chartered accountant, company secretary, chartered global management accountant, chartered management accountant, also ADIT, advanced international certificate, including ADIT, diploma in IFRS and whatnot. He has advised a lot of companies around 18 years of careers as, tax litigations, and the strategy side, compliance side. He is right now the head of group tax for Al Nabuda Group. He also worked in one of the big four before. So he has a great proven track record. We are going to have a good time with CA Rahul Dinodia. So without further ado, please welcome CA Rahul Dinodia. Can we have a louder round of applause first? A guy coming from 40 countries on the stage. Thank you so much.
Thank you. Good afternoon, everybody. I hope I'm audible. Just a small update. I wish I would have worked in 40 countries. I have managed the taxes for 40 countries. So it's as good as the same thing. And glad to be here. Thank you for that energetic introduction. So today, let's start with asking a question. After all what we have heard in the last couple of hours, how many of us feel that Pillar 2 is actually scary and terrifying? Just with a raise of hands. Yeah? I think all of us. So today my aim in the next, I have 45 minutes, hundreds of chartered accountants, and one goal is to make it sound less terrifying. And by the end of this session, when we leave this auditorium, at least we should carry some analogies or some stories with us that can help us understand all these jargons. At any point of time, we can go back and recollect, and these can help us in basically understanding what it means. Because technically, it's too heavy. Like 3,000 plus pages of document and on, it's very difficult for a human being to go through everything. So before I deep dive into the core topics, let me break certain things down so that we can use that as a foundation, building block, and then move forward from there. So, Rahulji, you rightly touched upon the geopolitics. I think all of us are very concerned with what's happening. And there is a lot of ambiguity around whether really Pillar 2 will see the light of the day. So how I personally see this is, just imagine beginning of the year, one guy very energetic in a group of friends goes to a lot of people, like other friends, and tells them, let's sign up for a gym membership. He encourages everybody to sign up. All of us sign up for the gym membership. We go buy the bottles, we buy our shots, and then we pay the membership fee. Couple of months down the line, what happens? only few friends are sweating on the treadmill. Now, who are those friends in today's time? EU. Taking selfies. Who was the friend who actually encouraged everybody to sign up for the gym membership? And what that friend is doing? Sitting on the couch having Burger King himself. Least bothered. And what happened to the rest of the people? Us? We're just thinking, why the hell did we even get into this? And that's a reality. So, this will help us understand the current situation of geopolitics in terms of pillar 2. What's really happening? Now, second thing which I'm going to deep dive today in is the QDMTT, like long word, qualified domestic minimum top-up tax. What the topic is, what it is. So, I can see most of us can relate to this situation. Imagine an Indian wedding situation. On the day of the wedding, dinner is served, and then suddenly the bill for the dinner comes. Two uncles from different countries, they raise their hand. We will pay the bill. Give the bill to us. And who are those two uncles? IIR and UTPR. But the catch is, we will pay the bill out of your own pocket. That is happening, or that was about to happen in UAE. But the bride's father was smart. He said, thank you very much. I will pay the bill here in UAE in dirhams, out of my own pocket. That is precisely what QDMTT is. Don't need to remember anything more than that, just to know what QDMTT means. That bride's father is UAE, agreed to pay the bill in UAE in dirhams, not letting IIR, UTPR uncles take away the credit and giving the financial impact on us, leaving the financial impact on us. Hope I was able to make it easy, simple and clear, which will stay with us. So tomorrow, I mean, not many of us would be from the tax background. So when we are into some discussions, we can at least relate to it and, accordingly build on the discussions. Now, Neeravji, you rightly touched upon another topic of free zones, tax havens. Isle of Man, Guernsey and all these havens are implementing IIR. So what does it mean? These are again topics that puts the mind off to sleep when we don't have the relevant background or awareness or information, and as a result we can't communicate in the same language with the people. So let me make it very simple for you. Imagine those tax havens as Dubai duty-free shop. Previously, you could walk to Dubai duty-free with your trolley, fill in chocolates, perfumes, profits, walk away without any taxes. But after they committing to Pillar 2 implementation, what has changed is you can still go to the Dubai duty-free shops. That means you can still go to the tax havens, enjoy the benefits of perfumes, chocolates, profits, with a catch that whichever counter you eventually go to, there will be a 15% at the counter. That's what has just happened when these tax havens have signed up for the Pillar 2 implementation. Now, if I make it even more simpler for you, imagine you going to some favorite chaatwala of yours, and that chaatwala is serving your favorite dish, but it's just that the chaatwala is saying now, I'll serve the same dish to the same taste and likings, it's just that I'll add 15% cost on the price which you have you were previously paying to me. Now, what as professionals, as people from industry or advisors to the board, we need to do is, we just need to find the chartwala that serves as quality chart with the least amount of heartburn later. That's the simple logic of implementing Pillar 2 in these tax havens. So I hope I'm clear with what is happening in geopolitics, what does QDMTT means, and what does the impact of Pillar 2 implementation in the tax haven is. With that background, let's deep dive. So the first is the Pillar 2 wave. I don't need to touch upon it. I think we have already looked at it. What is Pillar 2? When it gets triggered? What UAE has done is, by implementing QDMTT, ensures that the bill is paid in UAE, in dirhams, the money stays here, and it saves us a lot of trouble, effective from 1st January 25 onwards. So think of Pillar 2 as a fitness regime, to understand it simpler, better. No matter how fancy your corporate structure is, no matter how great you think double, that Irish structure, Luxembourg structure you can create, if your ETR is below 15%, someone somewhere will make you do those push-ups and make you pay 15% at least. Now, why this session matters? Not because I'm presenting, but why it really matters. Because after the confetti settles, Pillar 2 is not just a calculation exercise. Calculation is just one part of it. It's actually a transformation that your business, your clients would be going through. And that is an unprecedented transformation. And I can, from my experience, I've got my hands dirty and at times burnt into the implementation. I can tell, massive one. Because it requires humongous amount of data. The data points are endless, 250 data points. Most of you can relate to something which is happening now in UAE, which is e-invoicing. So how many data points e-invoicing requires, if anybody can tell me? 50, right? So when I talk to my IT guy is already crying. 50 data points, how can we manage it? I mean, I did not give him the heart attack that, boy, what is coming your way is 250 plus data points for Pillar 2. He might even resign and go. That's the transformation we are talking about in Pillar 2. And that is beyond computation. Computation is one complicated bit of exercise which I'm sure with the help of experts like Nirav ji and Deloitte, there will be tools and mechanisms, spreadsheets and systems by which it can be managed. Because it's not humanly possible to remember all these rules. Can't. And I mean, I can advise you, don't. Because there are chances you will miss something or the other. So what is going to come to your rescue is that your data points are clean. You have the right sources from where you can pull out those data which you actually need to feed into the systems or the platforms to do those computations. You have to revamp the governance. Your entire reporting needs to be relooked at. I have been in the region for past so many years, and what I have experienced is most of the businesses here have legacy systems. Now imagine getting the information out of those legacy systems. It's not going to be very easy. So it is a transformation that the entire business would be witnessing very soon. And I'll be touching this upon in the slides to come. Don't wait for the exam to start for you to start preparing for it. That's not a wise thing to do. Like, we all are chartered accountants, we know the importance of practicing and preparing in advance. So take it as an exam preparation. The better you are prepared, higher your chances of clearing the exam. It's the same thing. 250 plus data points. It touches almost every aspect of business, not just tax and finance. It's not just a tax exercise. From day one, tax professionals should make it very clear it's not only a tax exercise. Don't take it on your head, or you will be. It's a company-wide initiative, a company-wide exercise wherein you would need people from finance, from IT, from legal, from HR, from tax, every walk of the functions to come in, help and support. We will look into those data points as well on the basis of each different department. And the mistakes, it can have real consequences. Financial, which many people may not very much bother about, but reputational consequences, which everybody is very concerned of, at least in the Gulf. So, this isn't your regular CIT return. I was hearing many people talking that CIT was a massive exercise. CIT was just a sprint. This is going to be a marathon, or it could even prove itself to be a triathlon that you're going to run. And this isn't your regular CIT return. This is like you're going to assemble your IKEA furniture without lights, with multiple authorities watching over you. And some of the authorities are even waiting with the measuring tape to make, waiting for you to make a mistake so that they can send their uncles with the bill. UAE, I love UAE because of its vision. Very smart country. They realized what needs to be done, made sure it is done. They have implemented QDMTT to safeguard their own revenue. And very conveniently they said, we will follow OECD rules. ज़्यादा मेहनत नहीं करने का. But with the local flavor. We'll have the return deadlines, penalties, everything in place. But we will not tell you the return format. So you keep waiting and thinking in what format you have to actually prepare that QDMTT return for. So, in simple terms, the UAE said, let's look at the globe rules. If there is any extra tax that needs to be collected anywhere, why should we let others collect it? Let's collect it here. Very smart. But at the same time, what's even more important is UAE takes pragmatic approach. UAE has in its DNA a business-friendly country. It will never let that tag, be taken away because of these tax issues. It will always try to be competitive. It will always try to be business-friendly. It will give enough time. It will give enough clarification and guidance for the businesses to prepare. And as Ian was mentioning, we are also expecting incentives to come up. Because otherwise, how free zones would interplay when the Pillar 2 comes in is something that everybody is looking into. And with our neighboring country, Saudi, waiting to have that pull-in factor, UAE needs to be more ahead of the game before it turns more into favor of Saudi. So I'm sure because of that kind of a soft competition going between UAE and KSA, the businesses in UAE would have more favorable things or more favorable rules, options to structure themselves. Now, looking at the QDMTT, what needs to be filed? In UAE, we'll have to file a QDMTT return. Format is not yet announced, but the format you can just think as one container. What needs to be looked at is what actually is required to fill into that, which we will cover in the slides to come. So we'll have to file a QDMTT return. We'll have to file a globe return. Here are the timelines. The first return, 18 months. The next returns, 15 months. And it contains the jurisdictional top-up tax computation, which my colleagues have already covered. So we'll have to start looking at it from the year end. After the end of 2025, which is the anchor date from where all these timelines are calculated. So that's where your months would start counting, when actually you have to file these returns, the globe returns and the QDMTT returns. The QDMTT would be the main compliance event for the UAE entities, which would include your jurisdictional top-up tax calculations, your entity level data, safe harbor, and all the other supporting schedules. Your globe return again is something which is much more detailed, which will contain your country by country breakdown, your globe calculations, your elections, ownership, filing hierarchies, UPs, surrogate parents, and a lot of other details. So, as I said earlier, if CIT filing was a sprint, this is a marathon. And if you miss one step, you're not going to get any medal. So, the key takeaways are QDMTT is not an attachment to your CIT. Consider them both separate, independent. QDMTT is under Pillar 2, requirements, rules, has separate method of computation, data points needed. Consider CIT as your probably P1. QDMTT would be your inter. That could be the level of difference between the two. GIR is the globe information return. If UAE is the filing or surrogate jurisdiction, again and again I'm reiterating, expect significant data preparation. So, for those of you who are really interested in knowing what are those 250 data points, you want to have a look at it. I have actually attached one PDF document, which probably you would be getting after this presentation, wherein all those 250 plus data points are listed. So whenever you have some spare time and you want to get yourself, want to put yourself off to sleep, just open that PDF, and I'm sure after 5 minutes you'll be sleeping and you'll be having a very nice sleep. It'll put you off to deep sleep. 250 data points. After second page, your brain will say, thank you very much, I can't read further. It's so boring and it's so detailed and it's so onerous. Timelines are unforgiving. We have to watch the jurisdiction where we are actually falling in for the globe returns, because it might happen your GIR may need to be filed earlier than your QDMTT. It all depends on which jurisdiction you're selecting or you're operating in. So those are the things that you have to literally be very careful of initially. And internal alignment has to happen. So you have to now, if you're working in tax, take your colleagues from IT, legal, HR, out for lunch, dinner, try to make friends with them, because you would need their support. And you would need their support in real time. So start building those connections now, guys. So who files what? Which entity has to file which return? So just try to summarize it here. Ultimate parent entity, as we all know it by now, is the entity where the consolidated financials are prepared. This is the primary filing entity for the globe returns, if it falls into a globe jurisdiction. However, It can also assign a designated parent entity, like how we were filing CBCR reports into a surrogate parent entity jurisdiction based on our own preferences and choices. So we can have this designated parent entity who can file the globe return on behalf of the ultimate parent entity. So previously, Netherlands, UK were the favored jurisdictions to file those CBCR returns because they had wider treaty network plus a wider mechanism of sharing these files on an automatic exchange basis. So once you file in UK, you need not file in any other jurisdiction. You know it will be shared automatically with all the other markets. Same was with Netherlands. So that's where you have to pay a little bit more attention, and at the right time, you have to decide which is going to be your designated parent entity if you don't want to file it in your ultimate parent entity jurisdiction for any ABC reason. Then comes your filing constituent entity, which is the entity in UAE responsible for filing your QDMTT returns, which is required under the UAE rules. Surrogate parent, by now I hope everybody knows the surrogate parent entity definition. The UAE entity which can be voluntarily designated to file the GIR for the group acts as the group filing point, and there can also be a secondary filing entity. So go through these things. I know it's too much in the beginning and it's quite confusing at times for us to remember and recollect, but just a couple of broad things. Ultimate parent entity, simple to understand. Designated parent entity, filing entity, surrogate entity. These are the 4 entities that we need to know and select appropriately as per the need and as per the merits and efficiencies of the jurisdiction in which these entities are actually operating. So simple example or an analogy is this filing structure is just like an office birthday cake where everybody is around and everybody wants to take a piece of it, but nobody wants to be the one who is actually going to cut it. And eventually the poor UAE entity might end up holding the knife as well as the GIR return and going through all the panic. So when I say the poor UAE entity, there is no UAE entity in physical form. You are the UAE entity. You represent the UAE entity. Or your clients would be that UAE entity. So that panic button would be in your hands. Yes, this is a little bit technical. I'll try to make it simpler. What is going to be in the container of the UAE return and what is going to be in the container of the globe return? So broadly, the QDMTT return would include globe income calculation, which Deloitte has touched upon. Your covered taxes calculation, very important thing. Based on your current taxes, deferred taxes, which are attributable to the globe income, with the adjustments which many people have described. Not everything is permissible as covered taxes. At the same time, many things which we may think is not covered tax, but actually is covered as covered tax. Zakat is a classic example. Top of tax per jurisdiction, safe harbor, entity level schedules, detailed entity information, jurisdictional consolidation, election adjustments. These are broadly the things which would go into my QDMTT returns. We can expect the formats to be released later, but at least now we know that where to start, what all to expect. And maybe we can take one by one, because when you don't have the pressure, that's the time you can do it at ease and you can do it, more comfortably. Similarly, in the globe returns, it's much more detailed because it's group level information, especially if we're talking about large organizations, MNCs which have got operations into multiple continents, dozens of countries. This is going to be very crucial for your employers or your clients. This would require your jurisdictional country by country breakdown all the 250 plus data points would come into play here. Top-up tax calculations, not a simpler exercise under globe return. Ownership structure and elections. Your reconciliations, your safe harbor, all these elections you would have to make at the right time. So, what is the key takeaway? The QDMTT return is different than the CIT return, but it's more UAE focused, filed by the local entity in UAE. Globe return is global. It could be filed by your ultimate parent, surrogate parent, secondary filer, all depends on how you want to structure it. Both are interconnected. Consistency is the key to avoid any red flags and mismatches. So how can we carry this message home? Imagine QDMTT and globe returns are just like a couple on Instagram. And one is posting local stories and the other is also posting some stories, but that's a global story. But if they put two different versions of the same vacation, everybody would notice, especially the FTA would notice, and then you would get a real notice. That's where you have to balance both sides, make sure they are aligned. They are independent, but cannot be left in silos and isolation. My favorite topic, great data hunt. It's not hunt, it's going to haunt us. Very soon we all would be finding ourselves just like Lara Croft in Tomb Raider, raiding for the treasures hidden somewhere that we know is there, but we don't know where is it. And the path to reach there is too difficult. So pillar 2 requires unprecedented data granularity. Let's pray and hope it doesn't come. If it comes, it is going to be unprecedented data requirement. And data, as we all know, does not just reside in taxes. We have to now go to legal. They'll say, we are not available, we are busy. We'll have to go to IT. As usual, they'll say, it will take 6 months. We'll go to HR. They'll not be available again. Treasury, not my job, it's a tax thing. You don't know what to do. So guys, this is the budgeting time. Make sure you budget for the lunches and dinners with all these teams. Take them out. Start building the background. Slowly getting to know where are these data points saved and how can you get them, because it is going to help you. And the globe definitions very conveniently differ from your accounting definitions. You need to ensure you understand both. As chartered accountants, we all have studied accounting standards, but over the years may not have practiced it. So, thank God, it's time we would get all the skills brushed up. Our accounting skills, our tax skills, and there is no escape. Because you need to understand it, otherwise you'll not be able to move forward. You would not be able to make that adjustment. Unless you understand, you cannot define whether it is aligning or not aligning. So, we would have to rebrush our accounting skills, our tax skills, and accountants need to learn taxes, tax professionals need to learn accounting, and it's going to be an interesting journey. And if you think, oh, I have got SAP implemented, my systems are robust, I can get everything from my SAP. Like we are in the process of getting SAP implemented, and my SAP implementer very conveniently comes and says, sir, whatever you need, you tell me, I'll get it from the SAP system. Like he is so much, his confidence sometimes scares me. How can you be so confident here? It's like just like, Sunny Deol in his movie. He is confident. Bring it on, I'll take up anything and everything. But it doesn't happen in real life. And if you expect and believe that SAP can save you, then you might even expect and believe that your teenager room is always clean. So it's not going to happen. So what is the data checklist from the financial side? Some of them are very easy to obtain, the consolidated financial statements, parents and the subsidiary financials. I can see some auditors here. So it's the easy thing, low-hanging fruit, we will get it. Local GAAP versus the IFRS reconciliations, especially for the companies and the entities or jurisdictions which are operating into multiple jurisdictions having different, say some having US GAAPs or some having other non-IFRS related requirements. Identification of the permanent differences, deferred tax balances, top-up tax adjustments. These are some of the financial data which are needed. Some of the legal entity data which we would need is legal entity chart, clear ownership percentage, structure, TIN numbers, PE registration, JV structures. JV is just like, the hidden villain. And Neeravji, thank you so much for touching upon that. Please go and just search some material about JV. It's something which is going to give so much of headache and hair loss to all of us when we would be doing this pillar 2, especially if we have JVs. Why the hell they had to make it so complicated? We would have to get through that. Entity classification under globe, alignment with GIR structure is something that we would have to arrange as part of the data for the legal entity. Tax data, again, something which is relatively easier to manage because it is much more in control, I expect. Local taxes which are accrued, paid, already is available from the CBCR filings. Covered taxes, we would get. Deferred tax adjustments, we can get. Safe harbor eligibility is still something that can be managed. Intercompany payments, withholding tax tracking, I'm sure. With CIT getting implemented, all these things, most of these things should be in order by now. And we would have looked at it. Then comes the collaboration matrix, which we have already touched upon. The teams which are going to be your partners in crime in this journey. UAE filings, what do we need to keep with us? The GIR submissions, working papers, safe harbor, legal agreements, TP documentation, retention of these documentation, usually 7 years. I advise people to keep it for 11 years because there is a clause of 4 years in case there is a dispute, an audit. So why to lose our sleep over it? Better tell your finance function or the IT function who is the responsible person that kindly keep the documents for 11 years with one caveat. If you are going to delete or discard any data, please ask me because UAE rules say if there is a dispute, this period can extend further. So make sure you tell your people to have the data at least for 11 years preserved. And after 11 years to reach out to you guys and take your permission before deleting it. Specifically if there is a dispute. We don't know how things might, change in the next 11 years. So keep that caveat. Otherwise the data would be deleted and they would say, sir, you did not tell me. You'd say, that was understood and then gone. So what's at risk if we mess up? We'll pray we don't mess up, but what's at risk if we do? Penalties, of course, favorite thing in UAE. Suddenly a message will come. Reputational risk, the most scary part for the businesses in the Gulf. Nobody wants to take that chance. Spill over into the CIT audits. Increased risk of reassessments. So it's something that we all know. I've just put it across in simple language and terms. Think of this like missing your flight because you thought when the boarding starts, that's the time when you should leave your home. So you should know when your flight time is, what time you should reach the airport, what time the boarding starts, and accordingly you should plan your journey together. And that's what is actually needed when we are moving or migrating now from CIT, fever and flavor to Pillar 2. Is it getting too boring? I'm saving the best part, yeah, because this is all something that we all know. But as we all say, a good doctor does not wait for a patient to land in the ICU before the treatment starts. Similarly, the good tax professional doesn't wait for Pillar 2 to kick in actually before the planning can be started. So I can share some real life strategies that you can take along with you, advise your clients, give them that these are the things which you should look at this stage and start working on. Because this is the right time to plan. Otherwise, if you do it a little later, I think it's already a bit late. There are chances that GAR may kick in, but for some of you who still don't meet that timeline of 2 out of 4, still you have time to do some planning and strategies. So what are the penalty examples? South Korea has levied penalties which are daily penalties. Europe has levied heavy penalties, 200,000 euros. And we all know the penalties in UAE for late filing, missing the payments, etc. And what could be the real horror stories? Miss the safe harbor deadline, pay double taxation. Entity excluded by mistake, you fail the entire group return. Defer tax errors, miss the top-up tax calculations. So anything that you miss, you can imagine, I believe most of us are married here, so we can imagine, is just like forgetting to invite your mother-in-law to a wedding. You can invite her later, but boy, you will have to pay for it forever. So it's as crucial as inviting your mother-in-law to the wedding. Should be on your priority list. Cannot miss. Repercussions are huge. Thank you. Now, mystery of the missing front. UAE always keep the suspense. What's coming next? So, format not yet been issued. It's expected to align with the GIR schema and the UAE CIT portal. Data granularity we can expect similar to OECD. Practical challenges that we all should know. ERP integration with your globe return schema, your reconciliation between your financials and globe returns, because most of the cases, the audits do not fail because of tax positions. It fails because of missing documentation. Your documents are not contemporaneous. Your returns do not align with your financials. That's where, it raises the red flags. If your returns are aligning with your financials, at least that comfort is there in the mind of the auditor. So that reconciliation is very important. Language mismatch. Your financials are prepared on the language of IFRS. Globe returns speak a different language. You have to make sure both the cousins speak the same language, understand each other. Need for the manual data mapping unless the format is being issued. We need to start. We know we need to start. But if we start today, it is just like we are rehearsing a play without even knowing a script. And we know the critics are going to be sitting in the front row. But we need to do that, fortunately and unfortunately. So what are the best practices? Develop some mock templates. Speak with the experts, learn from them, understand how can you use your 23, 24 or 24, 25 data to do that mock run. Identify the gaps in the system. I have seen a common practice in the Gulf is people tend to outsource thinking. okay, we will pass it on to our consultant. They will help us with whatever needs to be done. No, it does not happen that way. You have to be on the steering, or you have to be on the driving wheel. Your consultant might be sitting right next to you, just like you are learning driving. He's an instructor telling you, you go left, you go right. But you have to hold the steering wheel. He might be an expert on the topic. He doesn't understand your business. You understand the business. Or you understand the business for your clients. So don't take that by just passing it on to somebody, they'll do everything which is needed. No, it will not be a good job done. You have to take the ownership, identify where the gaps, find those gaps, think of how to mitigate those gaps, and engage the IT teams and finance teams as early as possible for mitigating those gaps, bringing in appropriate systems or whatever automation is needed to help in bridging it. So, what are the common myths? Common myths that I have been hearing is, we can use the CIT data as is, filed my CIT return, so I've done the heavy lifting. QDMTT and globe calculations, they all require different data sets, would require different accounting adjustments, jurisdictional adjustments, deferred tax adjustments, eliminations. If you would try to use your CIT data to prepare your QDMTT return, your QDMTT return might look like a Picasso painting, which is very colorful, but may not be technically correct. Another myth, safe harbors will be automatically applied. It is not. It must be claimed through elections and filings. They're not auto-applied. And waiting, we will deal with the format later. The return format is not out yet, but the system alignment, data mapping, mock runs, it should start now. Waiting for the format is just like, as I said, waiting for your exam paper to be given to you to start studying. It's very brave, but not a wise decision. So, what are the key takeaways? Start the data readiness now. Pillar 2 is not about scrambling just 3 days before the filing. Map your data sources, identify your gaps, set your cross-functional collaborations early. It is going to be a triathlon. If you miss one of these steps, you might still be required to run the triathlon with one shoe missing. Imagine. Don't wait for the format. If you wait for the format, you may miss out on the important key time that is there with you now. If you keep on waiting for the format, the analogy I could think of is just like waiting for the wedding invitation for you to start looking for a sherwani. You may look, unprepared on the day when you have to go for it. Pillar 2 is actually, as I said, data plus governance plus documentation. It's way beyond calculations. Calculation is just tip of the iceberg. What is not seen to the naked eye, hidden inside the water, is the data. So, think about building audit-proof structure, defensible positions, and think of the entire process as like you're going to bake a cake where data is the flour, which is the key ingredient. Documentation is the sugar, which is going to give the real taste to it. Governance is going to be your oven. If you skip any one of it, your cake is going to be horrible. And penalties are high, stakes are really high. We have seen under the CIT rules, the penalties are already specified. QDMTT will be no different than that. FTA clock starts the moment your deadline is over. They don't wait. No excuses. Penalties will land. So, this is in a brief all about the compliance. And just like right tax professionals, what we need to do is we need to start planning for it. We need to start advising our clients to look at the structures. This is the right time. Move on with the consolidation structure. Look at the entities which you are consolidating now and the entities which can genuinely, be carved out of consolidation based on either the factors such as you may merge some of them with your parent entities. You can look at some of the entities which are loss-making entities because of which your globe income or your ETR is getting skewed up and down. You have to look at your other non-core activities. Practically what I've seen is in family businesses, the real estate arm, in family businesses, the investment arms, they are all put together. As a result, your 750 million euro threshold could get breached. So you can advise your clients to maybe create separate structures under independent holding company. If there is a passive income SPV, which actually is putting us into the 750 million threshold, why not put it under a separate holding structure or create an altogether different unique structure for it? Think from all those aspects. This is the right time. That is where the real value is hiding. And that is where your clients or your employer would appreciate you, because that is where you would be bringing something on the table which the board is going to appreciate. Because what is important for the board is what's landing in the bank. Except everything is just fancy. If you can really help saving some cash, everybody would be happy. So look at those structures wherein you have some entities getting some benefits in terms of tax holidays. Do you really need it? Because tax holidays are not essentially going to be considered as the covered taxes, but it can impact your ETR computations. Look at the entities which are operating into such markets where you may fall into the globe requirements, and those are maybe consistent loss-making entities or subsidiaries which could be liquidated or closed. Those are the areas other than computation where you can showcase your intelligence to your clients, to your employers, and tell them that this is how we can find an opportunity in a problem and help you save cash, which will be appreciated by anybody you're going to talk to. Will be more appreciated than doing the right calculation, in my humble opinion. And this is the time to start for it, because everything has to be justified. We can think of 100 of, being Indian Chartered Accountants, being jugadus by nature, we can think of 100 of such structures, but it has to now survive the test of time. It has to survive the substance rules. It has to survive the GAR provisions. It has to be basically, operationally and commercially justified. And this is the time to think over those aspects. And if we think Pillar 2 is overwhelming, don't worry, we are all in the same boat. But the smart ones are those who will start padding early.
Thank you so much, Rahul Bhai, for that power pack sessions. I would say in a very simpler way, but yes, I like your examples to make it more interesting, especially that the Insta one, because nowadays everyone is want to get noticed, but of course not by the FTA. So can we have a thunderous round of applause for the Rahul Dinodia? And with that, I would like to call our chairman, CA Jayaprakash Agarwal, the board member, CA Dikshit Jain, and along with that, our former chairman, CA Raju Menon sir, on the stage, and to present a memento to our esteemed speaker on behalf of everyone. Taliyan basti rehni chahiye, sir.
That is actually.
Thank you so much, CA Raju Menon, sir, Chairman Dikshit, and of course our esteemed speakers.
Yes.
And now it's time for what I like to call the grand finale. The sessions where everything we have learned today comes together in the most relatable way possible. Our final topic, the practical case studies and the key takeaways, will bring all those concepts, computations, and the compliance framework to the life through the real world scenarios. Because theory may tell us what to do, but the case studies show us how to do it and sometimes how not to do it. So, to formally introduce our final speaker, CA Akshay Kankre, for the day, may I now invite our ever supportive and the knowledgeable member, CA Yuga Murthy, to do the honors to formally introduce Ashish Kankre. Can I have a huge round of applause for my board member, CA Yuga?
Good afternoon, members. Good afternoon. See, if it is pillar 2 is like cricket test match, 2 Rahul Dravid already batted. Now the Akshay turn. We have all heard quite a bit about UAE pillar 2. That big global shift is taking in UAE from 9% to 15% corporate tax rate. In simple terms, it's a UAE way of saying we are part of global tax family now and we are playing by the same rule. It's all about fairness, transparency, and keeping our economy in sync with world. Of course, understanding the fine print of these changes can be a bit brain workout, which is why we are so lucky to have someone who can make even the trickiest tax topics sound clear and practical. Our next speaker, CA Akshay Kankare, is a chartered accountant with 2 decades of experience in transfer pricing and international taxation. He is the founder of Transprice Tax Advisors and has worked with over 750 multinational companies, helping navigate the maze of global tax regulations. Akshay has been recognized internationally, named highly rewarded practitioner by International Tax Review 2025, and awarded Transfer Pricing Advisor of the Year by Acromic Point. He is also an author, 3 insightful books, and a firm believer that tax should be understood, not feared. Today, he will be helping us simplify Pillar 2 through practical case studies and real-world takeaway. Please join me welcoming author, trusted advisor, and thoughtful leader, Akshay Kankare. Thank you.
Good afternoon, everybody. Thank you, Uga Murthy ji, for a very kind introduction. Thank you, Jai Bhai, for the invitation. Thank you, committee, for inviting here. What a fantastic day this has been. Half day of Pillar 2, and UAE is getting all serious about it. I have my practice in India and UAE. India has not spoken a word about Pillar 2 in the last 2-3 budgets. We have been thinking about it, that this time Pillar 2 will come in. Some element or what will come in. There has been discussions, but they have not come out. UAE has been forerunner in terms of getting the DMTT in. Okay, my job here is to simplify what has already been covered. I think what has been covered today is already simplified. Fantastic work, Nirabai. Laid down a great foundation and a groundwork on Pillar 2. Deloitte did a fantastic job. And then Ashiki 1, Ashiki 2, and Rahul 1, Rahul 2. So, Rahul, fantastic. My job is indeed very easy. How many of you have given surprise tests? In school, college, yaad karo wo din? Everybody? Okay. So now, all of you, whatever you have learned since the morning, this is the testing times. Because we are going to enter into the practicalities of certain structures in Pillar 2. Before that, I will simplify and give a summary, right? I just need the pointer. Is this the one? Okay. How do I change? Okay. So, before we enter into the cases, let's set a simple foundation. Why? We should always ask why Pillar 2 or DMTT came in. Very simple is that multinational corporations across the world, because they are spread across the world, they were enjoying tax arbitrages in different countries, right? They said it was a competition to go down in terms of taxes. So who is going to be more competitive? Then OECD came in, this was 2013 BEPS project. They said at least there needs to be 15% tax that every country should pay. It's not company. It says every country should have minimum 15% baseline, which means if every country has a DMTT regulation, you actually don't need the entire pillar 2, right? But that's not the case. Every country has their own sovereign policies in the way how they see taxes. That's why you have DMTT, you have IIR, and I'll tell you how these are just the modes of payments. Ultimately, the achievement that everybody wants to have is 15% of baseline taxes on a jurisdiction by jurisdiction level. So there needs to be a jurisdictional blending. Okay? Now, long discussions in OECD, UN, ever since I am studying transfer pricing and international tax, that what is the best method to achieve parity across? Is a global formulary approach the best, or is the arm's length model the best? And these were always fighting in the OECD boardrooms. Ultimately, it looks like both of them win, because you have the arm's length way, you have the GAR way, which is more principle oriented, right? Your pillar 2 calculation, you can club that under global formulary approach, where there is no logic. There are rules. See, when you take certain U-turns, you have to go, at least in Dubai, far away and then take a U-turn. Logic, why there is no U-turn for the next 2 kilometers? But there is a rule. So you have to follow rules. Rules often defy logic, right? So your entire pillar 2 or DMTT is a rule-based subject. So thankfully, I'll still keep my tax aspects with me. Plus, I will have to learn now the IFRS aspects. I come from an IFRS background, but still I will have to again go through those to look at pillar 2. So both of them now coexist and there is no tussle between these two. Now this is a summary, okay? This is a summary of what we have discussed since morning. There are 7 steps of achieving DMTT or a pillar 2. The first step, most important, and I would talk about it a little more because that's not been covered by the earlier one, that's in-scoping. You have various companies in your multinational group. Not all are covered. There are rules which are the companies that will be covered in your pillar 2 calculation and dynamics. That's called as in-scoping. That's your step number 1. Step number 2 is to look at distributing your income on a constituent entity to constituent entity basis and then add that together. That's called as jurisdictional blending. Then you calculate your globe income. UAE DMTT does not talk of globe income. It changes globe into pillar 2 income. That's how the definition is. Globally, it is called as globe income. Then you determine the taxes. You compute your effective tax rate. What is an effective tax rate? Simple accountant's explanation, current tax plus deferred tax divided by profit before tax. Nothing rocket science. And that's why I said I'm going to simplify it. Okay? There are certain adjustments to be done, but that's going to be rule-based, and some of the, I would say, softwares will do that for you. Of course, there are a lot of data points for sure. Then you compute the top-up tax and the payment mechanism of top-up tax. Okay, once you compute the ETR, the difference between your 15% and ETR is going to be called as top-up tax. First in the percentage terms and then in absolute terms. And there is a mechanism to pay that. That is called as QDMTT. So there are 4 options to pay. Simplifying things. The first option, which is a jurisdictional right for every country, is QDMTT or domestic minimum top-up tax. This gives the right for every country to locally collect that tax, right? That example of Rahul, who talked about the marriage, that one. Then you have income inclusion rules. Now this is the right which is not given to domestic. This right is with your ultimate parent company. Okay? Now assume that right somehow misses. Then the onus comes back to the jurisdiction. That onus of again paying taxes is through an under-taxed payment rule or under-taxed profit rule, which means any allowances of expenditure could be disallowed in such a way that your ETR goes back to 15%, right? And then you have STTR, which is, we have spoken about that, it's a treaty-oriented mechanism where payments made to countries with less than 9% withholding tax will be at 9%. And this is the reason why UAE started with 9%. It didn't start with 10% or 8%. OECD was already in discussions and they said we need to at least protect the tax at Dubai, UAE level, and that's why they went into 9%. Okay, now everybody clear with DMTT? For the last, I think, 4 hours, we have had a fantastic discussion. Now I am getting into the testing spree. I will be asking you questions, yeah, and we are going to solve it together. The person or people who answer them well, they are going to get a gift from me. Okay, or maybe a report card. What is that gift? It's not material, it is an IP. I generally believe in IPs. That IP is, I have summarized entire DMTT in 10 pages. That summary is what I'm going to mail to you. Similar to Rahul, I'm going to attach that. Okay? So let's look at examples. Everybody is ready? Everybody is ready to participate? Great. A little bit louder, please. Okay. I know I am standing between you and the lunch. Yeah? But let's make best use of the next 30 minutes talking about 15 examples. That could be 5,000 examples, but I have chosen 15 examples to speak about. Okay, let's speak about case 1. Simple case study. Okay, cakewalk for all of you. Grade 1 type of an example. So there are 2 companies here. There is Noor Textiles LLC and Noor Sis LLC. Clear? Now, these are held by 3 individual shareholders. Okay? Now, Noor Textiles LLC has certain subsidiaries outside UAE in all the countries. They are basically outlets. So this is into textiles, they are into outlets. Clear in terms of holding pattern? Let's get into specifics. Now, on my left is Noor Textiles LLC. Noor Textiles LLC has a consolidated revenue of 1,000 million. Is it one of the indicators for Pillar 2 or getting into Pillar 2? What is the threshold for Pillar 2? Kya suna nahi diya? 750 million. Very good. Now, Pillar 2 income for this Noor Textile LLC is 100 million. Am I in any of the de minimis? Safe harbors? Nikal gaya? Okay, great. My cover taxes is 9 million. What is my ETR? Do I calculate ETR like that? What is ETR? CT plus DT divided by profit before tax. Let's look at what is the deferred tax impact. Right? So deferred tax impact, I am saying there is a permanent difference. Let's not get into temporary differences. Permanent difference of 6 million. So my ETR now jacks up from 9% to 15%. Have I made a calculation whether DMTT should apply in this particular case? My ETR is 15%, guys. What is my top-up tax? So will DMTT apply to you for this group? Yes, no? Yes, please. Haath upar kijiye, please. वैसे हाँ तो DMTT applies everywhere, but I will pay a top-up tax here. Fantastic. That's the right answer. Everybody is getting that IP from me. Okay, let's have interaction. Okay, let's have more interactions. Let's talk about Noor Sis LLCs. This is into systems. Okay, now consolidated revenue of Noor Sis is 900 million. Pillar 2 income 100 million. I'm going to take this 100,000 million type of numbers only. Covered taxes is 9%. ETR is going to be 9%. Okay, what is going to be my top-up tax percentage gap? How many for 6%? How many for 0? How many for not applicable? Why not applicable, ma'am? It's a multinational group, right? There are 3 shareholders at the top. There are 3 shareholders at the top. Okay. Fantastic. So, because there are 3 individual shareholders, your consolidation rules don't apply to them. So, even though you are falling in all the right spots of consolidated revenue, because you do not fall in the definition of a multinational group, right? My next question, in that case, we all CAs are intelligent. Yeah? Can I now put things into place where I know if certain companies are held individually, they will not fall into the group? Can I do that? Rahul gave an example. But can I start advising and can companies start deploying a model where they come out of the group and they say, now I am held only by individual shareholders, so please, I am out of DMTT. Yes? How many say yes? Fantastic. How many say no? So no वाले सब hungry है क्या? No? Why no? Okay. Ideally you could, but you should have a business substance to do it. I will never say no. There are sense of possibilities always in taxation. There is a possibility that that owner really wants to be held individually because of XYZ substance and business commercial rationale. Right? So, in that case, yes, but there has to be a business rationale. Otherwise, GAR provisions will apply. Okay? Clear with this? So, we have clear with in-scoping. Now, what does DMTT do? Similar example, okay, but I want to stress on the SBI here. Consol revenue, 1,000 million. I'm not getting into the holding pattern, you can read it. What does DMTT do in such a case? You have an ETR of 9% in this, your top-up tax percent is 6%, and your excess profits are 200 million minus 50 million. Minus 50 million are substance-based income exclusions. We are going to look at a separate case study for that, but that is a benefit given to all the UAE companies which are in scope to remove certain 5% in longer run, 8 point and 9 point something percentage in short run of your employees and assets that you get as a credit, right, for having substance in the UAE. So they are rewarding you for having substance in the UAE. So that is your substance-based income exclusions. Now you have to reduce that from your excess profits, from your pillar 2 income, and that's how you arrive at excess profits. Once you have that excess profits, multiply that with your differential, which is the top-up tax percentage, you will get to a DMTT. But this is a calculation, we have all understood it. What's the speciality is, UK applies IIR. So UK is that uncle in the marriage. So if you have had a DMTT, then UK would have, as it is collected that taxes, might as well pay that in the UAE. So DMTT typically blocks IIRs. Yeah, and most of the countries right now, except for India, US, China, have IRR regulations. Clear with case study number 2? Okay, let's look at case study number 3. I have a free zone entity getting qualified free zone income, filing CT returns at 0%. And I am fitting in all the criteria of pillar 2. Shall I be happy? Not happy? Okay, let's see why happy or why not happy. Consolidated revenue again 1,000 million. You have pillar 2 income of 200 million. Covered taxes is going to be 0 because you are not going to pay any tax. It's free zone. Your ETR is 0, right? Your top-up tax percentage directly goes to 15%. Let's assume the same SBI benefits. You have 100 million of excess profits. Now your pillar 2 overall will override the free zone exemption. And you will have to do an addition of 15% back as top-up taxes and pay that to the government treasury, right? This ensures again that no IRR comes in. It also ensures UAE government gets the taxes. It also ensures that you are not getting any free zone exemptions. Clear? Okay. Now case 3, this is where I will need your participation. Everybody knows what a permanent establishment is? How many of you don't know what a permanent establishment is? Okay, great. So, how many of you know what a permanent establishment is? And rest? Hungry. Okay. So, consolidated revenue is 1,000 million. Okay. You have a pillar 2 income of 100 million. Covered taxes is 9%, top-up taxes 6%. Your DMTT in UAE, will it include permanent establishment income or not? Permanent establishment is indeed my extension, which is my arm getting consolidated into me, and ideally I may or may not be making separate financials for it. So it is other country. Okay, so shall I include that in the pillar 2 computation or no? So this is one of those 250 data points that you need to be aware of. So out of that 250, we are looking at 15. So the rule says no. Permanent establishment will be a separate entity, which is you will have permanent establishments in other countries. In this case, it is South Africa. So if there is a permanent establishment in South Africa, then your pillar 2 income will be separately calculated for South Africa. And if South Africa has DMTT regulations, which they have now, in that case, you will pay taxes locally on the permanent establishments there, although for CT purposes, you might be consolidating it here. Understood? So your CT taxes profitability and pillar 2 taxes profitability will be different. Logical? How is it logical? Most illogical. Why am I leaving out South Africa? I should take that revenue also and combine it. I don't even have, when I say I, it is UAE. I don't have an IR regulation. So if instead of Africa, it was Cayman Islands, I am losing my right to tax that. So it's not logical. So that South Africa will see, but I as a policy maker, a PE is an extension of a head office. A PE is not a separate entity as such, but the rule says so, and that's the reason why we need to do it. So everybody understood about this PE rule, it has to be treated as a separate entity. Okay. Okay, now there is a special rule. Here is where the complexity comes in. Now same situation, but the pillar 2 income in South Africa is a loss. What to do then? If a pillar 2 income in South Africa is a loss, then the rules change. They say it's my entity. Okay? And because you have already consolidated that in the city, so you take that loss and you combine it with UAE. So you take that loss to UAE and then you file your pillar 2 taxes. And the computation will go accordingly. The computation is, I think the computation here, it says, pillar 2 income earlier, which was say 100 million, which is still 100 million, then you will add losses of that, their adjusted pillar 2 income will be 50 million. So income come ho gaya, so what will happen? Will my ETR go up or come down? Anybody for down? Denominator is reducing, mathematics, rules. Okay, so if the denominator is reducing, my ETR will go up. So everybody happy in UAE in that case? So if you have profits, I don't want taxes. But if you have loss, add it to my income so that I can reduce the ETR. Logical? No, it is not logical. It's rules based, right? It's not principle based. So your covered taxes in this case is 9% and your ETR goes up to 18% directly. But the condition is, now this is where the logic comes in. The condition is, from the time your PE in South Africa starts making profit, whatever has been the loss that you have claimed, add that to the pillar 2 income in UAE and then start paying taxes. So you are only deferring your Okay? So this is what a special situation around PE is. I wanted to stress upon this because specially I have seen. So from an India perspective, we generally avoid PE. As an advice or as companies, we generally say we want to avoid PE until and unless there is a compelling reason for PEs to have. From a UAE perspective, there are a lot of PE existing already, right? So that it's convenience of business over anything else. So this is an important point for you to take away. Then as it is going to be a separate one. So if it is a subsidiary, there is no question. At that point of time, you will always treat it as separate, even in profit or on losses. दुख सुख में वो अलग ही है, ठीक है? यहाँ पे अलग है. Only when there is a PE. Now this is, I think, even in the morning we touched upon, is the exempt dividend income. Let's take an example. Your console revenue is 1200 million. Your pillar 2 income is 200 million. Covered taxes is 12 million. So your ETR is 6%, right? Now in this case, there has been a dividend payment from all the 3 subsidiaries to the extent of 80 million. Now when you are receiving the dividends, that is going to be considered as a non-tax income for you. It's exempt. So you will get a credit of it. So you reduce. So you saw those computation mechanisms that with Deloitte presentation had. One of them was exempt dividend. And you add, you subtract that from your pillar 2 income accordingly to get your pillar 2 income down. So if your pillar 2 income down, then your ETR goes. When your pillar 2 income is down, ETR goes down. Okay. Is everybody able to connect with these examples? Because these are simple examples. So the first trial balance I saw, okay, in my inter was this much. Exam, and I was very happy I was able to tally it. When I went into practice, practice in the sense as an article, I was with PwC Startment. The first day, they said we are printing trial balance for you. Entire day they were printing trial balance on a dot matrix printer. That was 250 pages. So my first work ever is actually to cut out those pages and to staple them together. That is what I did in my first year. Similarly, this is that exam wala trial balance. Actual situation is going to be very different, but these are founding principles. If you are able to connect with this, then you can actually connect with that, right? So, dividends always help to reduce your ETR. Okay, and there are certain conditions to it. Following? Okay. Lot has been spoken on JV structures, and I thought it will be great to have an example and discussion on it. Okay, so consolidated revenue of the, so there are 2 shareholders in this. The first shareholder is from UAE. The first shareholder has a consolidated revenue of 2000 million. Okay, my second shareholder is from France. It has a consolidated revenue of 3000 million. In UAE is a JV company. It has a consolidated revenue of 1200 million, pillar 2 income of 200 million, and covered taxes of 18 million. So let's speak a little bit about JV that we have already spoken about. Which is the consolidated revenue that you will consider for pillar 2 in this case? So there are 3 consolidated revenue I have given you. France, UAE and UAE subsidiary. So which consolidated revenue will consider for a purpose of JV? Sorry, thoda louder. 1200, but that's not an ultimate parent entity, right? You should actually be looking at a consolidated revenue of ultimate parent entity. Okay. JV accounting is done by what basis? Now I'll derive certain logic out of it. Equity method, it is not through a consolidation, line by line consolidation, right? So if you are going to consolidate on an equity method, ideally you don't have a parent. The law says, which is actually obvious but puts it into black and white. In that case, the JV itself will be considered as an ultimate parent entity. Understood? Okay. Now, say below the JV, this is not in the example, but I want to discuss with you. Below the JV, there is no company that JV is the ultimate company. Will Pillar 2 apply or not apply? How many say no? How many say yes? Why yes, sir? So JV is definitely a constituent entity. But is JV a multinational enterprise group, M&E group? Because it doesn't have other, so as Nirav bhai said, you need one company in one jurisdiction, other company in other jurisdiction, even if it is a PE. But there needs to be two jurisdictions. Here we are only saying that the JV has subsidiaries, and that's the reason why your JV will be an ultimate parent entity, UPE. And your DMTT will have to be calculated accordingly at a jurisdiction basis. Okay? Now what if, I'm changing the facts again, it's on the screen. What if my consolidated revenue for the JV is going to be 600 million? How many say applicable? How many say not applicable? Rest, please. कुछ तो एक स्टैंड लो ना, चलेगा, मैं नहीं पूछूंगा. Okay, so in this case it will not be applicable. Again, when I am saying not applicable, in your head should ring a bell that is there a restructuring possibility? क्या मैं कहीं से JV निकाल सकता हूँ? Right? Why you want to fall under Pillar 2? ठीक है? So think about it. But again, backed by GAR regulations, I am nowhere saying, Rahul sir said in starting that it is law of karma, that it is haunting and coming back. We don't want again that to happen. So if you have a business substance to it, do it. Okay? Again, there are different regulations on restructuring which are applicable in Pillar 2. There is a separate chapter on it. Okay, next one is easy. I have a shipping income of a multinational group. I have two businesses. One is the trading business and shipping business. I will treat my trading business as a separate business. I will treat my shipping business as a separate business. Only trading business will be covered for DMTT. My shipping business will not be covered for DMTT. Okay? Okay. What if I have a local shipping business? I don't have international shipping business. Next to Dera Creek, Dubai Creek, I am doing some shipping business in that creek. Will that be exempt? No, assume it is M&E. Assume Maersk doing shipping business in Dubai Creek. Nobody from Maersk, right? AP Moller Group, okay. No, it is only international shipping business. It's very clear. Everything is defined in your DMTT regulations 142. Okay. Next adjustment is on stocks. Now the way how people read it is that any type of stock options that you give, you just add back. It's not like that. There could be a difference between your stock discounts, ESOP discounts, stock options, these could also be sweat equity or whatever. The discount amount which is given in the P&L, that could be different than your discount amount in your tax returns. Now, if it is favorable to you, you please change the discount figure in the P&L by the tax amount. If you have claimed that in the CT, that is what the law tells you to do. So in this case, let's say you have a stock options under IFRS as 40 million and you have stock options as per taxes as 60 million. So there is an arbitrage, there is a difference. So you have Pillar 2 income of 200 million, you will add the stock options as per IFRS, claim a stock deduction as per taxes. Right? Again logic, koi logic nahi, rule hai. Okay? Are stock expenditures actual expenditures? Everybody knows what a stock expenditure is. A stock expenditure is basically the value which is discounted for while you are giving that stock to an employee or a consultant. So that discount, somebody has to bear it. So that is borne by a company and it will come into your P&L, right? One debit effect, another went into your equity share capital or share premium. So that discount amount is actually an expenditure. It's a non-cash expenditure to start with, right? So there is an adjustment to that account. It acts in your favor. But if the stock options are going to get expired in future, then you do not do this adjustment and you again increase your net profits or pillar 2 income. Getting complex? It is complex. It's not that easy. Okay? But again, all these plus and minuses will be in a software or maybe an Excel file. Excel is also a software which will tell you that this is one particular column that you have to look at your stock expenditures and see if you want to add them back. Okay, so that's an income adjustment for stock options for sure. Now let's look at another example. Now this looks like a JV, but it is not. It is a minority owned constituent entity. So there is a French shareholding which has a consolidated revenue of 3,000 million. There are non-corporate individual owners to the extent of 80%. And a French company is owning into OOT FZCO to the extent of 20%. Okay. Now whether the UAE company be considered for DMTT in scoping. Okay. Will a 20% shareholder be doing a line by line consolidation? Your question I am asking back. If it has a control, yes. And if it does, then it gets covered into pillar 2. Okay? Which again means, do you have a restructuring opportunity to say don't do line by line consolidation? Okay? So these all things are there where a lot of thought and intelligence will go in. Okay? Now, if you do not, let's assume you do not do a line by line consolidation, but the French country or France is having an income inclusion rule, IIR. Will it take the profits of UAE and tax there? Logically, yes. Logically also no. Logically, yes. Rule wise, no. Because if there is no consolidation happening, you cannot. Okay? So these are, okay, by the way, UAE regulations which have been adopted are exactly similar to what OECD has given, except for, say, the article number 2, where there is lot of UAE-ness in that, but otherwise it's almost a good copy-paste. So that's the reason why also now that the status is qualified. Okay. Next case is on jurisdictional blending. You have a mainland entity and you have a free zone entity. I told you free zones are not exempt out. Ideally, if there are two pillar 2 incomes, you combine these two pillar 2 incomes, okay? And you combine it in such a way that you have to do all the analysis of top-up taxes as if these three companies that you have are one together. Okay, so you add your pillar 2 income of, say, UAE mainland, of UAE subsidiary and UAE free zone together, and then see what is the impact. So in this case, this is called as typical jurisdictional blending. So ideally, if you see the mainland, you have a covered taxes at 10.8 million, which has a good 9% plus 9% ETR. But when you do a jurisdictional blending, your ETR falls from a 9% to 5.4% because of the existence of free zones in your group. So do you want to make a separate group for free zones? I don't know. Okay, but I'll. Yes, everything jumps into 15%. If your outside subsidiary is a permanent establishment, separate reporting, subsidiary separate reporting, permanent establishment with loss, you combine it with UAE. Their income is not going to get consolidated in yours and 15%. Whatever is UAE basis, it is only UAE jurisdiction that is deploying DMTT. So there is no penalization. They say that you need to pay 15% taxes. Otherwise, you will have to pay somewhere. take that offline. Okay. Next is the substance-based exclusions. I said we'll do some maths around it. So let's say there is a multinational enterprise with a consolidated revenue of 3,000 million. You have a pillar 2 income, scenario 1, scenario 2, both same. Your covered taxes are same. Your ETR is same. Your top-up tax is the same. But what is different is your assets and employees. So you are going to get a credit to the extent of 5% in long run. When I say long run, because currently this 5% is jacked up to 9 point something and 8 point something. Okay. So this assets and employees, you are going to get a credit of 5%. And there is a way of how you compute your assets value and employee value. In scenario 1, if you see, a 5% of B and C is not a substantial amount. It is 2.5 and 1. The remaining one is excess profit on which you are going to compute the ETR. But if you see scenario 2, your substance-based income exclusions, in this case, your SBI is more than your excess or your pillar 2 income. In that case, even at a 9% or 10%, you are home, you don't need to pay any type of top-up taxes. Okay? This is the importance of SBI, which also means simply, if you want to be out of pillar 2, try and do heavy investments in the UAE. That is what even Rahulji was saying. Right? So if you want to build substance, do more expenditure, you will get some benefits from a tax perspective. These are all practical things, okay? This doesn't come out through theory. This is when you start doing the calculations, you will start understanding these things. Now, as I said, your covered taxes is just not current tax, it's current tax plus deferred taxes. So the there's a big deferred tax calculation that you need to do. But let's take an example of an expense here. So if you have a covered tax of 5 million, you add deferred tax of 4 million in this case. So your ETR ultimately will become 9% and your top-up tax is 6%. Never forget to miss out deferred taxes. As tax guys, we stay away from deferred taxes. I generally say, Mr. Auditor, accountant, please give me the deferred tax amount. I don't get into it. But now we need to. Now as tax guys, we need to get into the IFRS side of it, and the line between accounting and tax is going to get blurred if you are going to get into pillar 2. Last 2 cases remaining. I have 20 seconds, but I will extend for 2 minutes. This is a full-fledged scenario where you have a UAE entity called as Emira. It is fully falling under pillar 1. We are going to look at interactions between IIR and DMTT. So your pillar 2 income for the UAE entity is 5,000 million, city is 450 million, and your effective tax rate is 9%. You have a drop down into Emira India. Okay? This Indian company has a pillar 2 income of 100 million. Why India doesn't get into the pillar 2 side? Because their ETR always is more than 15%. So there is no use of pillar 2 as such. Right? So your covered tax is 30 million, ETR is 30%. Would this be combined anywhere? No. You are paying enough taxes in India. Similarly in UK, if you see with this example, DMTT is at 10%, so you are going to shell out an additional DMTT in UK, because UK also has DMTT regulations. So you will shell out DMTT in the UK by the UK company. Emira UAE doesn't get anything. Now peculiar, and this is where the big devil is. Emira US does a pillar 2 income of 500 million, covered taxes is 50 million, having an ETR of 10%. No DMTT applies in the US. And somebody has said this, the biggest tax haven in the world is the US. Okay? So, there is no IIR also in UAE, so you cannot attract your subsidiaries' income into your computation. So UAE loses to that extent, but that's a call that UAE government has taken. It's best to start with DMTT, right? US is not going to adopt pillar 2, but it is going to adopt something called as UTPR. And that is in discussions, which means if they think the ETR is falling down, they will not get into anything else, but they will start disallowing the expenditure. So instead of DMTT, they are getting into a discussion around UTPR, but at a local level. I said one thing, if everybody adopts DMTT, you don't need Pillar 2. Right? But if US doesn't adopt DMTT and it's adopting UTPR, it is going to complicate your global scenario around taxes. So in this case, US chhoot gaya. Then let's come to Emira, UAE, FZC. Your DMTT is at 5% and you will pay that DMTT in UAE itself. Okay? Clear with this structure? Which one? So your ETR is 10%, right? In this case, this ETR is 10%. So the difference between 15% and 10% is 5%. Okay, now last case, same things. Only instead of UAE, I am changing that to Netherlands. My holding company goes to Netherlands. If my holding company is Netherlands, US nahi bacha. I will have an IRR in place and I will pull the profits from US and tax it in the Netherlands because it has IRR regulations. So which means US profits are not US's anymore. And this is the reason why US wants the Pillar 2 to fail. Okay? Now these are what I have done strategically also is that I wanted also to give a lot of theory to you from a process perspective on applicability. So these are the 19 steps of review that every company will need to do. So I'm giving it to you here. And then what should companies do? I'm going to give it this to you for your reading. Okay, I'm not going to cover all of this. This is all what we have already covered in the theory. So these were the case studies that we discussed. If you have any doubts, I'm more than happy. I'm available here after the session. And so thank you for being a wonderful audience.
What a perfect way to close the technical journey of the day. You managed to turn Akshay bhai, the complex text structures into the relatable stories, real life learnings with your case studies, even a few laugh along with your humor we were talking about in the beginning of the sessions. So thank you once again, ending the day with the clarity and the confidence and that much needed. Of course, your humor is always there. So with that, I would like to call our chairman, CA Jayaprakash Agarwal, our vice chairman is also here. And along with that, the board member, CA Yuga Murthy and CA Vijay Mohan to do the honor and present the memento to our esteemed speaker. Vice Chairman Sahab, I already called your name to present the memento. Can I have a huge round of applause for CA Akshay Kankare? I request Ashna also to please join. Balram, please come.
Thank you.
Members, don't go anywhere. We have the 3 raffles with us. One is the iPhone 17, and second is the Bose speaker, and third one is the Sony headphones, all courtesy by the Windmills, the iPhone courtesy by the Young Global, and the Bose speaker is courtesy by the Reliant Surveyors. But yes, the lunch is open at the back side. You can either go from the left or right. It's just a little bit walk is there. But yes, if you want to get lucky and want to win. But before we do that raffle, I would like to call my board member, CA Vijay Mohan, to do the formal word of thanks because it's always necessary to show the gratitude to all the speakers and of course our gratitude to all the members as well. So I request Vijay Mohan to do the please formal word of thanks. Can I have a huge round of applause for Vijay?
Thank you, Amit. Actually, half of my work is already done by Amit, and you all can't go without listening to it because we have 3 raffle draws are here. I'm not taking much of a time. Thank you for the enlightening session today morning we had, and I hope that Pillar 2 we all learned about Pillar 2, and I know that there is a lot of calculations are involved, and we all have to spend a lot of time if you wanted to understand that. The implementation of the global minimum tax by UAE is a bold step towards to be very competitive with the global economy. On behalf of the ICAI Dubai chapter, I would like to extend my heartfelt thanks to our brilliant speakers, CA Neerav Shah, CA Jan Roderick, CA Bomit Gangar, CA Rahul Bavre, CA Rahul Dinodia, and Akshay Kankare, who made these complex topics too engaging and relatable. A warm thank you to Chairman Sri Jayaprakash Agarwal, the executive committee, and the sponsors and partners, and the entire team of ICA Dubai team for the organizing such an event. And also our special thanks to the Higher College of Technology for giving us the opportunity to conduct these events over here. Above all, a heartfelt thank you to each one of you, our members, guests, and participants, for your enthusiasm, curiosity, encouragement. Your presence and active participations are what truly make our gatherings meaningful and successful. Thank you once again for being part of this memorable event. Wishing you a pleasant and fulfilling day ahead. Thank you.
Perfect, Vijay. Everyone was waiting. You complete, then kisko iPhone jayega. Okay.
Let's start with I think Sony headphones are there.
Sony headphones by?
All courtesy by Windmills.
Windmills. As you can see, Aishwarya smiling. Aishwarya, come please. Give a round of applause for Windmills for sponsoring the speakers. Sony headphones. So many gifts. मैं confused हो रहा हूँ.
I feel आज मुझे लग रहा है आपका speaker जीत के जा.
Sony headphone के लिए let's take out a name, but उसके लिए let me call Prakash साहब, please come. सर क्या होता है ना, एक जन जीतेगा 400 की बद्दुआएं मिलेंगी, मैं क्यों लूं? आइए प्लीज.
Lots of cards are bubbling out. अभी देखते हैं किसका कौन सा कार्ड प्रकाश
No, please.
इसमें से निकालते हैं सर. Yeah. Everybody is watching you.
Ashna, come on the stage. Balram, come on the stage. Any of the committee members left, please come on the stage. हाँ. Okay. मालूम है रूल तो आपको मालूम है, जो होगा रूम में उसको ही मिलने वाला है. How many are Pandes here? पांडे, हाथ उठाइए. पांडे. तनुज पांडे. उनका हाथ उठ कर तो रुक गया. तनुज पांडे, कम. आप जीत चुके हैं सर. तनुज पांडे. Give a round of applause to Tanuj Pandey.
From the lens, he was watching the color of the card, so he was ready.
ऐश्वर्या, इधर आइए ऐश्वर्या, दिस साइड. हाँ, का साहब आइए प्लीज. सर जिसको ताली मारेंगे उसको आईफोन मिलेगा, चांसेस है, मैं बता रहा हूँ. ताली से नहीं मारेगा नहीं मिलेगा. कॉन्ग्रेचुलेशन. थैंक यू सर, थैंक यू वेरी मच. थैंक यू ब्रदर. नेक्स्ट क्या है अपने पास ऋषि भाई?
Is boss speaker, I think around 500 dirham Samit, right? So a good one from Reliance Surveyors. So
Boss
that is
speakers.
there. Very interesting.
चलिए बॉस स्पीकर के लिए देखते हैं who will do it. I can see Raju sir was there. Raju sir left क्या? Okay, perfect. जैन साहब आ जाइए सर. Please. अरे नहीं सर, मैंने बोला ना कि हम क्यों करें, हम क्यों लें. एक पास चेयर को कोई कुछ नहीं बोलेगा. So please come and please help us in finding that one person who will win it.
हाँ
अच्छा लालच हमको मिल जाएगा. अगर मैं आऊंगा तो कैसे मिले? नहीं सर, आपका नाम भी आया तब भी आपको दे देंगे. And it is Mr. Jain. नहीं sorry, नरेंद्र पात्रो. नरेंद्र साहब, अरे क्या बात है.
Big round of applause. Worth attending pillar 2.
Can we have, please come. आप आइए, प्लीज आइए, सर के साथ आइए and you will be presenting it.
भले ही छोटा बैग है बट साउंड फुल पावर वाला है. डोंट वरी नरेंद्र जी.
एक क्वेश्चन पूछूं नरेंद्र साहब, आप घर जाने के बाद इस स्पीकर से आपकी आवाज बुलंद होगी कि वैसी की वैसी रहने वाली है घर जाकर?
ये तो घर में ही पता चलेगा.
चलिए, गुड. थैंक यू वेरी मच. कॉन्ग्रेचुलेशंस. एंड नाउ द लास्ट वन. That is iPhone 7. को iPhone 17. How many of you want it? अगर एक ही बंदा उठाएगा तो उसी को दे देंगे ना. अच्छा, सबने उठाया. ओके, सबको चाहिए. For this raffle, I saw RAC chapter chairman.
प्रमोद जैन साहब यहीं पे थे, कहीं थे, वो रहे, दिख रहे हैं एकदम. Sir, we love to have you always in our chapter events. Round of applause for प्रमोद जैन साहब.
10 बजे का इवेंट है. He must have started by 9 o'clock from 8:39. सर 8:39 से हैं. थैंक यू वेरी मच फॉर कमिंग. और देखिए आप किसको आईफोन देना चाहेंगे आप?
मैजिक आपके हाथों में है.
कमिटी का कार्ड मेरे को ऊपर में पहले दिख रहा है.
मेरा कार्ड तो दिखना ही बंद हो गया है.
सर बोल रहे मेरा कार्ड भी इसके अंदर है. वेरी गुड. गुड. नाम है, ये नाम पहले भी आया है, पहले कुछ लेके गया नहीं मालूम मेरे को. नाम हुआ है मनीष इलात.
ये मनीष भाई,
अरे क्या बात है, क्या बात है.
He is running the
स्माइल देखो सर. पिलर 2 भी सीख के जा रहे हैं, फोन भी लेके जा रहे हैं. प्लीज कम. एक तालियां बजा दीजिए, होता रहेगा रैफल हमेशा अगर इस तरह आप लोग सपोर्ट करते रहेंगे स्पॉन्सर्स का. एंड प्लीज यंग ग्लोबल के लिए तालियां बजाइए. यंग ग्लोबल हैज बीन स्पॉन्सरिंग दिस आईफोन एवरी इवेंट. थैंक यू.